refresh our knowledge. The essence of this program is to refresh our knowledge on particularly the core aspect, one of the core areas of our profession, the central point of the profession, which is property valuation, in preparation for our interview with ESVARBON. This incidentally happened to be like a crash program, because as a matter of fact, the academy, we have a full-fledged internship program, fill gaps in terms of knowledge and experience on property valuation for who candidates that want to have a interview, or that want to just refresh knowledge. Now, but because of the closeness of the interview, we have decided that let's have interaction. Normally, this program is supposed to be of 2 sections. We have a section for refresher class, to refresh our knowledge about the fundamentals of property valuation. And we have a section for practical application, which is meant for candidates to apply the knowledge, the fundamental knowledge, to create practical solutions as far as property valuation is concerned. So before I enter into the full discussion, I recognize the fact I was told that ESV Balogun, Ridwan Balogun is already online, is one of our faculty members at the academy, and is equally one of our management team. Can I have a word from ESV Balogun if he's there?
Good morning, sir. I'm here, sir.
Good morning. How are you?
I'm fine, sir.
So, thank you. I appreciate the fact that you have been there. ESV Balogun is going to be running with me, pending when other panelists will come in, particularly some other faculty members. Majority are actually targeting 11 o'clock. So pending when they will come in, I will be anchoring this program with ESV Ridwan Balogun. And our focus is to have chats, to interact with the members in this group on likely areas of questions that we can expect in our ESVARBON interview, particularly focusing on valuation. Because ESVARBON is very particular about valuation these days. And of course, the essence of your seal is for valuation. Most often when you need your seal, it's for valuation. So we want to, we are motivated to do this so as, number one, to refresh the knowledge of all participants and therefore increase their capacity as far as property valuation is concerned with this crash interaction. Then number two, to enhance the prospects of success in ESVARBON interview. And that is secondary, actually, but that is very paramount to us now. So on this note, I will want to start by saying that our focus on property valuation actually depends on our skill areas as assessment surveyors and valuers. What you claim to be your skill areas, what you claim to be areas where you are working in your firms or in your ministries and what have you. For example, candidates that have written CA on property valuation should be ready to face serious questions on property valuation. So if we have any of the participants here that have written CA on property valuation, please feel free to ask us questions beyond what we'll be asking here or what we'll be discussing. Because what we want to do now is a kind of refresher class on fundamentals of property valuation. Fundamentals of property valuation, particularly looking at the applications and the practice. So on this note, I want to say that our focus will be, number one, well, I don't expect ESVARBON to ask us what is property valuation, but we might equally need to interact on that. just to refresh our knowledge as a way of introduction. But the key issues we'll be discussing about purposes of valuation. What does it mean? And what are the available purposes? We'll be discussing about basis of valuation. What are basis of valuation? What does it mean? And what are basis of valuation? Not as lecture, but as questions. We will put questions to audience. We expect members of the audience to respond, just indicate or simplify, then you will respond. And if we have concern about the response, we will correct. If we don't have, we'll agree. And it then means that while members of the audience, any member is responding, other members should equally listen carefully so that all of us will share this knowledge together and go and answer the interaction with ESVARBON with a degree of confidence. So we will be looking at basis and what are the categories of basis. Our questions will center around all these ones. We will have questions and interaction on methods. What are these type of methods? What are the processes involved in each of the methods? What are the premises? Under what condition we use one method or the other? And if we have time, we'll consider valuation assumptions. So before I open the floor by asking question, do we have anybody here that has a question that is pertinent to him that you want to ask first? If there is anyone, please just indicate by raising your hand. But if not, I will start by asking our own questions while we prepare for answers. I take it to mean that there is no one, so let's go ahead. Now, let's start with what do we understand property valuation to be? Anybody to explain what is property valuation? This is a meeting, not a webinar, so you can either indicate your hand or you start talking. If there is no chorus, fine, no problem. Whoever wants to talk, please. Property valuation, what does it mean to you? Yes, I'm not hearing Edna Ude. I think Edna Ude wants to say something. Hello? You can unmute yourself. You can unmute yourself.
Okay, can you hear me now?
Yes, I'm hearing you now.
Okay, Edna Ude is actually on the move, but I can make contributions even while I drive.
Yes, go ahead.
Property valuation, from my understanding, hello?
Akinlolu, please mute yourself. Yes, Ude, you have the floor.
Okay, property valuation, from understanding, is the process of determining value or worth of a real estate asset. The act of determining, using some parameters, to determine such value. Hello?
We are with you.
So it's using some, parameters to determine the worth of a real estate asset. That's what I understand by property valuation, sir.
Okay, thank you. That is fair, but it's not apt enough.
Okay,
is fair, is not apt enough. I have a quick question on that, but that question for audience to start thinking about it is that when you say real estate asset, what do you mean?
Fixed asset, fixed asset, fixed asset.
Yes, even at that, it's not vivid enough.
You're right, sir. You're right, sir. Because the valuer can equally determine other non-fixed assets too. So I will want to amend it, is a process of determining value, putting the worth of, our property.
Okay, even at that, it's not fulfilled enough. Property, let me pick the word property there. It's not fulfilled enough yet. So, and there are other missing links. Let me hear from Sulaiman Oladende. Sulaiman Oladende, you have the floor.
Morning, sir.
Good morning.
Can you hear me, sir?
Yes, very well.
Okay, so I think that's just a follow-up to last contribution. Determining of monetary worth of interest. I think the word here, interest in land, for a specific purpose at a given point in time, or a specific point in time.
I think that is fair. That's a better definition for fundamental. If we are going to advance, there are further ways of explaining property valuation. But talking about fundamental, right? That is fair enough. Not to waste our time. I have a lot of hand raised up, but let me quickly just summarize that you are to determine the value of an interest in a particular types of property. So types of property is of consideration. Interest in land is of consideration. What makes property a property is amalgamation of both physical and legal attributes, both corporate hereditament and incorporeal hereditament. And that is both the physical land per se and the interest that subsists in it. You cannot claim to have a real estate asset if there is no interest subsisting in it. What anchors property ownership is actually the bundle of rights that subsist in it. So what you do as a valuer, and this, I am emphasizing this because a lot of us, we go out there for inspection and you only do physical inspection. You don't verify the title. You don't even know what is the unexpired term. Maybe it just has about 13 years to go and you consider it, you place value on it as if it's a freehold interest. Valuation inspection has two dimensions, the physical inspection and the legal inspection. That legal inspection is your abstract inspection, and that is title search, title consideration, tenure information. So you need to analyze that to be able to determine what is the value of the property. So interest in a particular types of property, it can be residential, it can be commercial, it can be what have you, right? That's then for a specific purpose. Value varies with purpose. We will see that as we proceed. For the same type of property, we'll see that as we proceed. For a specific purpose and at a particular time. Other issues are underlying economic conditions, range of alternative investment, and what have you. But even if you, for the purpose of interview, you just mention all these keywords, specific, the value, if you look at that explanation, it more or less summarizes the principles of valuation. Concept of value is there. Interest in land is there. Types of property or land use is there. Date of valuation is there. Right? Your purpose of valuation is there. So you have quite a lot of issues around fundamentals of property valuation. So, and range of alternative investment and underlying economic conditions. You see, all this will guide what's called parameters that you have to consider. So let's pay attention to that. At our level, I think that's an adequate definition because it actually brings to fore a lot of valuation concepts and issues. So I don't know, before I go ahead, I still have hands raised. Hands of Bashir Rafiu, if I'm right. Abina Few. Is it still on this issue? Please, do you want to just make contribution quickly? Because we don't have time and we have a lot to do. You can talk if you still have something to say. Bashir Ali Nafiu. Your hands is up. Do you want to say something? Otherwise, lower your hand.
Okay, sir. I'm trying to add more on it, but I discovered that your explanation and the second speaker has made it very clear by adding the timing and the purpose.
Okay, thanks so much.
Okay. Yes, thank you very much.
It's okay, thanks. So, and in terms of questions, there is one thing that we left out in that definition, actually, and that is to say, is the arts and science. Is the art and science. Because in terms of question, they can ask you, valuation is an art and a science. What does it mean? If they say it's an art and a science, what does it mean? Right? Basically, let me just explain that, then we can move ahead. It's a science, it's actually a science because it's a surveying exercise. It follows scientific procedures. You have scientific theories and processes to adopt. Data collections process is scientific. Data analysis process is scientific. Now, but the arts aspect of it is that there are cases where, because it has to do with human studies, analysis of human behavior in terms of consumers in the market now, then there will be need for intuitions. Sense of best judgment will come in. And that's the art aspect of it. So valuation being an art does not mean that you should always be biased with valuation. No, because even if you want to make assumptions, it should be an informed assumption. Even if you want to make intuitions in terms of your personal opinion as valuer, it should be based on experience. And that's what we call sense of best judgment. Please, let's pay attention to that. Now, before I go to purpose and I go to basis, let's pick date of valuation. What is or when is the date of valuation? That is a question that you can be asked in this kind of interview. When is the date of valuation? So if you want to answer that quickly, anybody, when is date of valuation?
That should be the date of inspection.
That is the date of inspection. That is very apt. Johnson Okunlola.
Yes, it's the same thing. It's date of inspection.
Thank you.
Date of inspection is date of valuation. Thank you, sir.
Okay, thank you. Now, further on that date of valuation, there are exceptions. There are some conditions where your date of inspection will not be your date of valuation. Can you mention two? That is the fundamental. The date of inspection is your date of valuation. That is fundamental. And you have reasons for that, you know, because valuation is as a particular date. That's number one. Number two, as you are, after your inspection, anything could have happened after your inspection. So you make sure that you note your date of inspection as your date of valuation. So that if that will be your reference point, your reference date. In an event of any eventualities, thereafter, you will not be liable as valuer. But there are exceptions to that rule, to that principle. There are some conditions where your date of valuation will not be your date of inspection, or date of inspection is not date of valuation. So I want you to tell me what are those conditions. Now about three, but I can limit that to two. Well, anyway, for purpose of knowledge, let's talk about the three, right? And what are these three situations or conditions and when will be the dates of the evaluation? Anybody to answer that? You want to raise up your hand or you start talking? Please note that your date of inspection is your date of valuation, because a lot of people, there are confusions about that. We've been hearing a lot of people saying a lot of issues around it, but there are exceptions, about two or three exemptions. So what are these three exemptions? Noble colleagues, we are waiting for you.
May I speak, sir?
Yes, go ahead, please.
One of them is where you carried out probate valuations.
Probate, valuation for probate, yes.
Which the date of inspection will be the date in which the person died, or the estate, the date you are giving for the estate. The date the person died, basically. Then I think, for example, if you're doing some rating and they are going backwards in terms of the year in which you're doing the rating, they'll tell you to give a particular date in which the valuation of an asset is being valued.
Okay, Mr. Akintoye, right?
No, this Uche.
Not Uche. The guy that spoke now is Akintoye.
Yes, sir.
Yeah, Mr. Kintoye, I
Yes.
agree with you that one of the exceptions is when you are valuing for probate. What if you are valuing for probate? What then will be your basis of valuation?
The basis of valuation will basically be what the market value is as at the date in which the person died.
What's name is it called? What's the concept of value?
For me, it will be the date in which the person died, and it will be a retrospective.
No, Mr. Akintoye, we have market value.
Yes, sir.
That value, that value concept, what's its name?
It's a retrospective value, sir.
Retrospective value.
As at the date in which the person died, sir.
Akintoye, is that rooted in valuation?
I've forgotten the term, sir, but
it's better when you forget, just tell your panel that, oh, sorry, I can't recall that.
Okay, sir.
And you will not be crucified. It's
okay,
not
sir.
good to waste their time if you don't know.
Okay.
Yes, we really want to talk about that.
All right, so
you conclude.
That value concept is called principal value.
Oh, yes.
So that is the market value of the property as at the death date of the owner.
Yes,
you understand?
Yes, I remember. I forgot the term, sir. I'm sorry.
Yeah, okay. Then when you are valuing for rating, you also make mention of rating as one of the reasons why your date of inspection will not be a date of violation. Am I correct? Mr. Akintoye?
It is bad.
He said?
I think, yes, read one.
Sir?
I think it needs to, that rating, yes, there is situation of rating, but it's not fulfilled enough. Let's hear from somebody. Uche is raising his hand.
Okay.
Let's hear, maybe you'll be able to put that in the right perspective. Then you can now ask your question. So Uche, you have the floor.
Hello?
Hello?
I can't hear you. Hello?
It's like Uche is not audible.
Okay.
We are not hearing him.
Yeah, we can't hear him.
Okay. And do we have any other person to modify or to, re-explain? The first one is apt, probate valuation. And the date of valuation there is the date of death of the owner of the property, that's the deceased. And as ESV has said, the basis of valuation under that, the appropriate terminology is principal value. It's principal value. And there are reasons for it to be principal value, and he has explained that. The market value of that property, as at the time the person died, you are measuring the sweat and wet of the person, not anything that has been added or subtracted from it after his death. So the second one actually has to do with rating valuation, but it was not properly put in the right perspective by Uday.
That's
so
correct.
Is there any other person that want to attempt? Anybody to attempt? I want this attempt so that everyone can ask his question on this aspect that we are talking about. Yeah. Nobody? Okay. let me just say this, is rating when the property is for inclusion on current rating list. When a new property is to be included on current rating list, then the date of inspection will not be the date of valuation. The date of valuation will be the date of the general rating valuation that was done, that the list is still pending. I mean, that is still operational. Because rating valuation is quinquennial, is to be done every 5 years. Within the space of the last valuation and another valuation, new property can come up. When it comes up, such property is required to be reported for rating purpose. And when that property is to be assessed, it has to be assessed based on the situation as at the time of the general rating valuation list, the previous valuation that produced the current list. So that there is what we call tone of valuation list. Tone of valuation list requires uniformity and it requires correctness. These are what we call tone of valuation list. Uniformity and correctness. Uniformity, that is the basis of assessment of all determinants, should be uniform, so that there will be fairness and equity in the assessment of rating. Correctness in the sense that the analysis should be seen to be correct, and that you should not sacrifice correctness for uniformity. For example, let's say 3 years ago, general rating had been conducted, and it has produced a list that is running. A property is to be included today, and it has been assessed. But during the course of the general rating, rating valuation, there was error. You will not, because you want to ensure uniformity in the one you want to include now, and still commit the same error. That's the aspect of correctness. So what we should take for the purpose of interview is that rating valuation for inclusion on current rating list. Rating valuation for inclusion on current rating list. That is when your date of inspection will not be your date of valuation. That date of valuation will not be the date as when the general rating valuation was done. So, and I've explained the conditions that warrant such. So I don't know if anyone still has questions for members here on this same aspect before we move further.
Well, what I just want to ask is that if we are valuing for the purpose of rating, what should now be the basis of valuation?
Members, you have the floor. You have the floor, please.
Let's make it interactive. You know, this is not your interview yet. So
then it's not a lecture either.
It's not a lecture, yes. So please, let's hear from you. Or let me put it this way. What is basis of valuation itself? Members?
Can we, yes, we're done.
Sir?
I will suggest you start with purpose of valuation.
Okay.
So
okay.
Let's move from purpose to basis. So let your question be, what do members understand as purpose of valuation?
As purpose of valuation, yes.
After that, they tell us different purposes.
Yes.
And they have to explain. Then after that, we now go to basis. They will explain what basis is. Then they tell us different and so on. So that we have a flow of scheme.
Okay. Yes, sir. Yes, sir.
Okay, so the floor. You have the floor, members. Or you want me to start calling names? Huh?
I think somebody is already raising up.
I don't see a hand, so.
John Ekerete.
Okay, he's trying to talk, but he didn't raise. Okay, Joanne, go ahead, please. Joanne. Ekereke. I mean, it's a kerete. It's a kerete. Okay, let's hear from anybody. Or let's assume today is your day. Okay, I have John. I have Johnson.
Johnson, Okunola.
Okay. Yes, go ahead, please.
Yes, sir. Thank you, sir. The purpose of valuation has to do with the use to which valuation is to be put, meaning that the reasons why evaluation should be, or the reason why evaluation wants to be carried out, you just have to tell us why what is the of the valuation. Thank you, sir.
That's good. That's fair enough. Fair enough. Reason for valuation. Yes. Client's objective for the valuation. Huh? That's your purpose of valuation. Why does the client requires evaluation? Right? Very good. Very good. Okay. So Ridwan, you want to go ahead?
Yeah. From there, what are the various purposes of valuation? Having know what purpose of valuation is, that's why the valuation is required. What did the client want, need the valuation for? That's the purpose of valuation. So what are the various purposes of valuation?
On this note, I have the pleasure to call Michael Kalu. Can you tell us 5 purposes of valuation, you know?
Yeah.
Michael Kalu, unmute yourself. I want to make it more interactive, please. Michael Kalu, unmute yourself and talk to us. Purposes of valuation, just mention any 5. After 2 seconds, if you are not responding, you have the option of calling a friend within this panel. I mean, within the audience, within people in attendance here, you have the option of calling a friend.
Hello, sir.
Kalu,
can I say something about that, sir?
No, let Kalu talk. If Kalu is not talking, then you should call a friend. We need to make it interactive. Kalu. Kalu is not talking. Maybe he's not even part of us here. He's here now. Unmute yourself. You want to talk? Michael Kalu. Okay.
Hello, sir.
Olamide, go ahead, please.
Sir.
Olamide, go ahead.
Yes. Valuation for insurance purpose, for investment purpose, on mortgage.
We asked for 5. You have mentioned 2.
3.
You mentioned 2. There's no valuation for investment purpose.
I have a question for you.
Okay, sorry, my noble colleague.
I'm asking, what do you mean by for investment purpose?
Okay, you mentioned 3. I take it to me, you mentioned 3 then. Okay, so I asked for 5. You want to call for lifeline? You want to call for lifeline? Olamide.
Valuation for purchase.
Valuation for purchase. Who is that? Bashir Ali. Good. For purchase, yes. Go ahead.
Valuation for sales.
For sale, yes. Go ahead.
And we have the other valuations for like the statutory valuations.
What are they?
Compulsory purchase.
Compulsory purchase.
Okay.
Compensation valuation.
Compensation, yes.
Like,
compensation, okay.
Performance management.
Pardon?
Performance measurement.
Performance measurement. How do you mean?
How the investment is performed.
No. There is no valuation for performance measurement. I ask you that because if you are talking about financial, for financial purpose, there could be something relating to that. But with your explanation, no. But I have Adeolu Ali. Adeolu Ali, you want to say something?
Adeolu Ali.
Adeolu Ali.
Morning,
Yes, please.
Yeah, my name is Adeola Aliu.
Oh, sorry, Adeola. Sorry about that.
Aliu, yeah. Okay, the purposes, different purposes of valuation. You have mortgage reasons. You have for buying and for selling of a property. You have for insurance purposes. You have for rating and taxation. You have for tax purposes. You have for acquisition and ledger purposes. You have for plant and machinery purposes. And you have for matrimonial purposes. That's in case of divorce.
Plant and machinery purposes. Is that the purpose of valuation?
Oh, no, it's not a purpose. It's not. I take it out. It's not. You have for tax purposes, then you have for acquisition and mergers.
Acquisition and mergers. Okay.
Would you consider going concern the purpose as well?
Longest time.
Going concern.
Sorry, Adeola Aliu.
Present, sir.
Please, when you say a mortgage, what do you understand by a mortgage?
Mortgage is when you want to get money from the bank to buy a property, and the bank will ask you to bring a form of valuation to know the worth of the property.
That you want to use as what?
As a collateral, sir.
Yeah. Because you must bring out those points.
All right, sir. I'm on the move. That's why I'm doing. Yes, sir. Sorry, sir.
All right. I think that's okay. Anybody again? Then also when you say Adeola Aliu, still on you. When you say
yes, sir. Yes, sir.
What do you mean by that?
Acquisition and mergers, that's when companies are merging up, like during the banks, when the banks were merging up, each bank bring their assets, the value of their assets to know how much you are bringing into the new business. Like recently you have Wema Bank, another bank acquiring Wema Bank, or Union Bank. There's another bank that has acquired Union Bank. So the new bank brings its assets, the old bank brings its assets, so they know who has more assets. So you have to value those properties. Then you have the purpose, that's the purpose, because they are.
What is the difference between acquisition and merger? Or are they the same thing?
No, they're not the same thing. Acquisition is when one is taking over the property. Then merger is when the two of them come together.
Okay. It means that they are still both parties are still in operation. Both entities are still in operation. Is that what you mean?
Yes, sir. Yes, sir. When both entities are still in operation.
Oh, thank you. I think I think that is okay. Thank you very much. And I don't know if my boss has question for the candidate. I don't know. Before we go to the next question.
Thanks so much. Yes, we read one. I don't really have a question as such, other than to make one or two clarifications. Number one is that, well, yes, we read one as quickly mentioned, well, subject to my reaction the other time, that there's nothing like investment purpose. That is one. Two, I've always been seeing even some documented, research and what have you, even some books where when talking about purpose of valuation, they will talk about valuation for capital value. They will talk about plant and machinery valuation, as Adeola mentioned, erroneously, according to her. They talk about mineral valuation. They talk about intellectual property valuation. mineral valuation, intellectual property valuation, plant and machinery valuation, they are not purposes. We should know that each of them can be valued for different purposes. There are different categories of, just like your land and building valuation. Then you have all other categories of valuation. So we should note that, please, noble colleagues. Then having said that, let me equally mention that other purposes, you know, today, somebody had mentioned probate. It's part of your purpose.
Yes, of probate rating compensation.
Yes, then we have flotation of shares. We have for financial reporting. I expect you to mention financial reporting because it's common in Nigeria practice. And that's what we call for accounting purpose in the olden days. Foundation for financial reporting. Get ready to answer questions on what is the basis, you know. Then you have for liquidation. You have for privatization. You have for commercialization.
Yeah.
All these are different purposes too.
And for the purpose of divorce.
Yes. And under personal purposes, just like he mentioned divorce, today you have for application for visas.
Visa, yes.
Right? So we should, in short, the purposes of valuation are so numerous, just like as human wants are unlimited. Right? So let's have that at the back of our mind. Meanwhile, let me quickly mention, for the purpose of the next question, that purchase is a purpose. For sale is another purpose. Some people have mentioned that earlier, but when Adiola was to respond, she joined the two together, buying and selling. They are not the same, right? For purchase is different from for sale. Okay, so now before I throw the ball back to Ridwan to move to the next question, that's under the basis now. Let me quickly, before I recognize my faculty member here that has joined, let me quickly react to, I think it's Louis or somebody that asked whether you can consider going concern as a purpose. No, the answer is no. As we get to basis, you get to understand that better. Now I have the honor to recognize ESV Kamaldin Lawal, who happens to be, number one, is a faculty member of the academy. Number two, is equally members of the management team. Number three, is the coordinator of this program. He has been the one anchoring the coordination of this program with the training coordinator. So ESV Kamaldin, you are welcome.
Okay, thank you very much. Good morning. Good morning, sir. Good morning, everybody. We let me first of all, I know you have been welcome. I want to use this medium to also welcome you to the webinar and to also let you know that this is Risk Academy. We are a center for real estate development here in Lagos. Center for Real Estate Professional Development here in Lagos. Now, what we need to do is one of the CSR, corporate social responsibility, that Risk Academy always have in stock for members of Nigerian Institution of Estate Surveyors and Valuers at any point in time when they are going for, whether it be it's a NAEF's interview, ESVARBON interview. We just concluded our preparatory class for those who just who wrote November exam diets. We are also going to be starting the May-June preparatory class for the May-June diet, but hopefully by 14th of January 2023. So we are doing this as a pro bono service, just to ensure that all of you come out in flying color in the interview. So please feel free to ask questions. When you are asked a question, when you don't know, say you don't know. This is not the actual interview like our director of studies said earlier. this is not the interview proper. We are just using this to extract certain information from you to be sure that when they ask you question, you'll be able to, what you will say will be the correct thing. If it's not correct, we'll tell you, oh, okay, this is how to put it. You know, so general advice will come later, but why we have started with valuation is that ESVARBON is very serious on issue of valuation, because the seal you are going to get is basically, we are estate surveyors and valuers. Here we survey and we value, okay? But the core of our profession is valuation and appraiser. So we are expected to, for ESVARBON, we are expected to know, to have good knowledge of it, so before you can skate through the interview. So please feel free to ask your question, and also where you don't know, say you don't know, then we'll be able to guide you. Thank you very much. Then the other thing I want to say under the date of valuation, Director of Study, I think then Mr. ESV Balogun, there's something that just came to my mind when you were discussing when the question on date of valuation came up, that what is the date of valuation and what are the exceptions. Then there's something I want us to add. Maybe Mr. Balogun, please, I want you to help us add this. Suppose somebody carries out, you have an evaluation assignment, and this valuation assignment is a very big one. Maybe you are valuing a factory, or you are valuing property that's very big, that will take you, the inspection will take you like 3, 4, 5 days to conclude the inspection. Which of these 3, 4, 5 days do you take as your date of inspection, which will metamorphose into your date of valuation? Do you take the last date? Do you take the first date? Or do you take the middle date? Which will you take as the date of valuation when the date of inspection is more than a single day? I think this kind of question,
the last day
can come up.
The last day.
Yes, Balogun, please.
The last day is better. That's the conclusion.
Hello.
Okay, let's hear. Yes, Balogun. They said the last day. So please.
I don't think so. You have multiple dates of valuation.
Hello.
I reason that in that case, you may have to have multiple dates of valuation. Maybe if you have for building A, you put the date for building A, building B, you put, if there are different dates, you state the different dates.
Okay.
That's
Does anybody has any other thing to say before ESV Balogun respond?
Please, I quickly step out from my system.
Okay.
I just came back now, so I did not get.
Okay, so what I said is that when you were discussing the date of valuation,
okay,
that is when the question came as what is the date of valuation and what are the exceptions to the date of valuation, I said something quickly came to my mind, that there are instances in practice where we value a property, extensive property, that will require 2 days, 3 days, 4 days to inspect. That which date do we take as the date of valuation? Is it the first day, the third, the second day, or the last day? And a good number of them said the last day. And somebody now said that you can have 2, 3 days of valuation. So please, can you throw lights on that? Thank you.
All right, thank you very much.
I want to say something.
Okay.
Okay.
Yeah, I'm thinking that you can say from so-so date to valuation carried out from so-so date to so-so date. I think that will cover the 3 days, since you did the valuation in 3 days.
Okay, thank you.
Thank you too.
Yeah, so before I go to my response, I quickly want to draw the attention of ESV Lawal, because some of us might not understand him well. So he said this program and the priority class, some people will misunderstand it to be the preparation for NAIS exam is pro bono. That one is not pro bono. It's only this one that we are doing that is pro bono. So please, so don't go and
Thank you very much.
All right. Now, the last speaker, I want to go along with the last speaker. If you have instances where the date of valuation, the date of inspection span more than 1 day, let's say up to 3 days. So when you are reporting, your date of inspection will be will be all those dates. It could be from 11th to 15th of that particular month. So it is all the days that you use in for the inspection that will constitute your date of valuation. Are we together? And in some instances where, just like somebody said here, if you are inspecting different properties at different locations, you can say, okay, well, this property in this particular location was actually inspected on so date. We might have different property in different locations that belong to only one client. So you report it. When you are reporting, you report each property separately. And so you can, under the date of valuation, you can say this particular property was inspected on this date. But if it is in a particular location and the date of inspection span more than 1 day, so the date of inspection will be all the days that was used for the inspection. I hope it's clear.
Okay, yes, please let me just have something. So what Valuation is saying is that when he said all the dates, what he's trying to say is that if, for instance, 3 days, 11th, 12th, and 13th. So inspection was carried out, inspection report was carried out from 11th of November 2022 to 13th November 2022. I hope you understand that. Thank you. Okay, so yes, Balogun, the next question.
Yeah, the next question, as we have understood what is purpose of valuation, and we have given.
Yes, Balogun.
Sir,
1 minute, please. Let me call your attention to a question on the chat.
All right.
The question says, what about valuation for goodwill? The person says, what about valuation for goodwill purpose? I.e., in terms of company merger and acquisition. The person is practically referring to purposes of valuation that we discussed.
Okay, sir.
He's now asking question that, what about the valuation for goodwill? For goodwill purpose, he put purpose actually, and that went further to say, in terms of company merger and acquisition. Before we continue, let me just clarify that. When you are to value goodwill, it's as good as saying you are doing intellectual property valuation, or you are doing valuation of intangible assets. Valuation of intangible assets. Valuation of intangible assets or goodwill valuation or patent rights valuation can be for whatever purpose. You have indicated it on your chart yourself. You say in case of company merger, goodwill valuation is not a purpose. It's an aspect of the valuation that can be required in case of merger, but not, in fact, it can even be required in case of dissolution of partnership, right? But not, and in case of sales and what have you, but not a purpose on its own. Just like, for example, if you want to do company asset valuation, under that company asset valuation, you have different categories. Company asset valuation will comprise land and building. Plant and machinery will be there. Valuation of their intangible asset like goodwill, patent rights, trade secrets will be there, right? So in this case, they are not purpose of valuation. They are aspects or category of valuation that you can do for various purposes. And as you have rightly put in your chart, you have indicated that in the terms of company merger, that is the purpose that will require you to carry out goodwill valuation among all other assets. So please, noble colleagues, let's note that. I think based on my comment now, I don't know, other questions is coming on. Okay, other comments? Let me say, Kamaldeen should please monitor the charts as Ridwan proceed. let's commonly monitor the chart, because I think what you have here relates to okay, they say if inspection date is in a location from 11 to 15 November, what is the date of violation? That is exactly what they have said.
We have addressed that.
They've addressed that. If it covers a period, you make that period your reference dates. And if it's in a location, if it's a different location, actually, it's better and safer, as Ridwan has said, to treat each property respectively. Because the essence of it is for you to avoid liability. If you just put range, you still leave questions of, as okay, when exactly did you inspect this one? You know, that is if they are not in the same location. But if they are in the same location, fine. Then can divorce or matrimony be a purpose? For divorce, there is violation for divorce. It's a purpose. It's a purpose. Okay. So yes, read one. Over to you. Take it up. Yes, I suggest ESV committee should continue to monitor the charts. Thank you.
Thank you, sir. I'm doing that already. Okay. Yes, read one.
All right.
Staff, maybe you should take it off from this. The last question that our DOS mentioned. Can divorce or matrimony be purpose of violation? He has said yes, divorce is a purpose of violation, but matrimony here, I hope the person is not thinking we are talking about marriage of persons. No, what we are matrimony here, I think yes, the read one. This could mean marriage. Maybe the person means
yes.
So all right, thank you.
Yeah, thank you very much. Well, I've not experienced what is called valuation for marriage. What I think the person want to ask is there's money that or there's sum that is being charged the spouse that requests for that divorce, and it is called alimony. Maybe that is what the person want to ask. So when you are valuing for divorce, you are valuing for divorce in order to establish the alimony to be paid. So there's nothing like matrimony. Matrimony, that is marriage. I hope the person is clear now.
Okay.
The person has even said, yes, he said he meant divorce.
Okay. Yes. I think there's another question here on financial reporting. The person asked that does valuation for financial reporting synonymous with performance measurement or balance sheets?
Well, in those days, we used to call it preparation of balance sheet, but it's now valuation for financial reporting. In fact, for financial measurement, performance measurement is also an option of financial. Are we together? Thank you.
So I think those are the questions we have on the chat for now. So we can continue. So I'll be monitoring as soon as we get more questions.
All right.
Thank you.
Okay.
Hello. Let me add to yes, we read one's response on that financial reporting.
All right.
Yes. I would rather direct the candidate to the international valuation standard. I think standard IVS 300. So, and that talks about this valuation, the purposes we have for carrying out.
Hello? 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 Are we still there?
Hello?
Yeah, hello, sir.
Hello?
Can hear you, sir.
We can hear you.
Okay, I think the audio of our director of studies.
Okay.
Yeah. Maybe it's the network from his end. We can't hear him anymore. Okay. Yes, Balogun, please continue while we wait for him.
Okay. Since we have understood what is purpose of valuation, so the next question for you, noble colleagues, is now what is the basis of valuation? Or let me say, what is basis of valuation? You know, like just the way we answer the question, what is purpose of valuation? To which you have, you know, wonderfully responded, and we are glad. So please, what is purpose? What is basis of valuation? Noble colleague in the noble profession, yeah, we are listening. Okay, is Mr. Bashir trying to say something there? Bashir Abdul Tawfiq or something?
I think, can I make an attempt?
Yes, please. Okay, Luis Okonkwo.
Yes, please.
Yes, please, go ahead.
Basis of valuation will be the grounds under which the valuation is being carried out.
He said?
That will be the grounds under which valuation is being carried out. For instance, maybe to determine the open market value, the indemnity and the reinstatement value, the existing use, liquidation. I hope I'm right.
He said the grounds. Come again.
Yes. I said the base will be the grounds for which the valuation is being carried out.
The grounds.
Basis is value concept.
Please, Anna, please.
Which has to do with the method of valuation.
Luis Ogongo, please, we are hearing you.
Hello. Hello, yes, Balogun. Hello, yes, Balogun. Yeah, please, just a moment. This is going to the candidates. Please, let's.
Yes, I said this is value concept.
Hello.
The what?
Hello, let's be organized. Somebody was responding. Let's wait until that person finish before they raise their hand.
Basis is valuation.
Okay, I think she's not here. Please, let's hold on. When the person finishes, then we recognize another person to talk. We have 2 hands up already. Somebody was talking. Please let that person continue, then we can call others to talk. Thank you.
All right, thank you so much, sir. Okay, can you hear me, sir?
Yes, we can.
Okay, I said the basis of valuation will be the grounds. By the grounds, the method. What the value intends to achieve in the course of that exercise.
What the value? You mean what the value or what the valuation?
What the valuation intends to achieve.
Okay.
What the valuation intends to achieve.
Okay.
For instance, maybe you want to determine the open market value of the property. Is it insurance? I don't know. Liquidation and stuff like that. This will be basis for valuation.
How do you distinguish that from purpose of valuation?
Purpose is the reason why the valuation is being carried out.
Basis is what?
The method, the purpose is the reason. Then basis will be the method through which the valuation is being carried out.
No, see, that is why I want to get it clear.
Okay.
The purpose, yes, you are good. And what you explained me even before was even better than the way you have now put it now. Because you have tried. Let's hear other view. Oh, yeah. Mr. Komodi, yes, you Komodi, please.
Hello.
I think we have another hand.
Yes, we have Mr. Akiade Akilulu and we have Mrs. Anna Oludele raising their hands. So let's go with Mr. Akiade Akilulu, please. Mr. Akiade Akilulu, are you still there? Or the response the previous person made is in line with what you wanted to say?
Maybe
No, sir. No, sir. Hello, sir.
Hello. Okay, go ahead, please.
Okay. There is a clear distinction between the purpose of valuation and the basis of valuation. The purpose of valuation is the reason and the use or the problem in which the valuation is to solve. Why the basis of valuation has bearing on the hello, sir. Why the basis of valuation defines the approach in which the valuation is to follow. Thank you very much, sir.
All right, thank you.
All right, thank you.
Mr. Balogu, please be noting. Let me call other people so that we can wrap everything up. Then, Mrs. Hannah Oludele, please. You have the floor.
Yes, sir. Yes, the purpose of valuation is the reason why you are carrying out the valuation, e.g., insurance, probate, and so on and so forth, which we have talked about earlier. But the basis is the value concept of the valuation, and it borders on the method of the.
Go ahead, we are listening.
Valuation.
No, we can hear you, ma'am.
Hello?
We can hear you.
Hello?
Hello, we can hear you.
I said the purpose of valuation is the reason why you are carrying out the valuation.
Okay.
For example, insurance, for insurance purpose, or sale, and so on and so forth. But the basis is it borders on the value concept of the valuation, and it borders on the method of valuation.
Okay, thank you. Yes, Balogu, you have noted that. Let me go to, I have Mr. Akiade Akilulu. Can you put down your hands? Then Mrs. Anna Oludele, can you also put down your hands? Then I have Mr. Abubakar Mohammed also raising his hand. Mr. Abubakar Mohammed, please. Those of you who have sent something in this chat, questions in the chat, I've seen them. We are going to read them. Never mind, you get answers to them. Mr. Abubakar Mohammed. Okay, I think after, if it's not there, it appears that all the hands are down now. Maybe they are satisfied with what other people said. Okay, let me go to the chat in case some of them relate with the lecture on ground. Okay, I have. Okay, somebody in the chat, Mr. Sulaiman. The moment said. Okay. Said basis of valuation is the rationale for carrying out evaluation. Then basis of valuation is the principles on which evaluation is premised. Mr. or Mrs. Adeshola Adewumi. Okay, Mr. Adeshola Adewumi said basis of valuation is the principles on which evaluation is premised. Then they also have methods of valuation. They are two different. Okay, we have heard you, Mr. Adeshola. Thank you for that. Okay, so I also have Miss ESV. This guy is already using ESV. I hope ESVARBON will not. ESV Olamide Adigun. Yes, you have the floor.
He has not yet faced ESVARBON. Let the person remove The acronym ESV.
Mr. Olamide Adigun.
Hello, sir.
Okay, please go ahead.
I think.
Hello, sir.
I think we should not say they should remove ESV. In the first instance, I learned that even in their induction, they were referred to as ESV.
That's correct, sir.
So we should not be the one to tell them to remove ESV.
That's correct, my guy.
They cannot put RSV, registered surveyor and valuer.
Okay,
But,
they can be ESV.
Even at the induction, under the presidential.
Even we have a plaque.
It's a title given to us, sir.
That's an error.
You shouldn't
It's
say
not an
that
error, sir.
ESV Balogun, because the custodians of the institution actually, directed the coordination, prepared their flags and their planks. So they should probably they know that they are entitled to use ESV.
Thank you so much, sir.
What they did is to ginger them.
No, sir.
Okay, so let's continue to ginger them. Let's continue to ginger them.
Try and encourage yourselves.
Hello. ESV Adigun. Let's before you respond to that question, let me say something in line with the use of ESV or not using ESV by somebody who has passed NISB interview. You see, to my knowledge, the acronym ESV is a creation of Nigerian Institution of Estate Surveyors and Valuers and not of ESVARBON. And the reason is that once you become an associate of NISB, you have become a professional member of the institution. Once you are an associate and fellow are professional members. So this acronym was ratified by NIET's Council to be used by professional members of Nigerian Institution of Estate Surveyors and Valuers. Perhaps that is what they have in mind, and that is the reason why after passing associate interview, upon your induction, you are being called an estate surveyor and valuer, and you have been given permission to use that ESV. So I think over time we have been thinking that okay, maybe it's ESVARBON has, and I think to my knowledge, I know it's a creation of Nigerian Institution of Estate Surveyors and Valuers. So like our director of studies said, since Nigerian Institution of Estate Surveyors and Valuers on their own, I've given them ESV, I've allowed them to use ESV. Let's continue to allow them to use the ESV, even if it is to just be encouraging them, as we are encouraging them now in this chat.
But not RSV.
I know they can't use RSV now because RSV is registered surveyor and valuer, and it is only ESVARBON that grants RSV. So thank you very much. So yes, Adigun, you have the floor.
Yeah, thank you very much, sir. I just want to buttress what my other associate member saying and about the basis. My better understanding of the basis has to do with the principles and guidelines that one needs to know while carrying out evaluation. Having understood properly the reasons why a client actually wants to carry out or ask us to carry out the evaluation of him. So that's to do with the guidelines.
Okay, thank you very much, Estate Surveyor and Valuer Olamide Adigun. Before I go to those who raise their hand, please just a moment. Let me quickly read what we have in the chat. A lot of people have sent messages here regarding to the discussion we're having. Mrs. Yemisi Onisarutu, I'm sorry I didn't pronounce that name well, said bases are the methods used in arriving at a value. I also have here Mr. Sefiu Kolawole Adebola and Adebola Adedoto. So we have base of valuation is the fundamental measurement principles of a valuation on a specified date. Then yes, I'm just reading all this so that at least when you know how to correct people, you know how to correct their the inadequacies in what they have said or what they have typed. Then we have Aregbesola Titi Lokpe Alero. The basis of valuation are the methods of valuation. Then I have Jerome. Purpose of valuation is the reason of carrying out the valuation. Example, insurance, probate, etc. Base of valuation is the approach or principles that guides the valuer in arriving at the value at a particular date. Then the last here is basis is the grounds and guidelines and principles by which or upon which the valuation is performed. Okay, I think we can't take any more. For those who are raising up their hands, I will just take two so that we can end this part because of time. Mr. Olawale Legusi. Sorry if I didn't pronounce that name well. Please, you have the floor. Hello. Hello?
Sorry. Yeah, sorry, I've just typed, you've just read out my comments on what I wanted to say.
All right, thank you very much.
So that's fine. So we can save time.
All right, thank you. I have Mr. Abubakar Mohammed is back. Mr. Abubakar Mohammed, you have the floor. Hello? Hello? Okay, well, I think he has problem with network. Mr. Johnson Okunola, can you have the floor?
Okay, thank you, sir. I just want to add to what my other colleague has said. The purpose of valuation determines the basis of valuation, while the basis of valuation determines the method of valuation. And according to IVSC 2007, they noted that the basis of valuation describes the fundamental measurement principles of evaluation at a specific date, meaning that the basis of valuation has to do with the measurement of, or the, let me say, the measurement of principle of evaluation. Thank you, sir.
Okay, all right, thank you very much. I think we can end that there. So yes, the Balogun can now respond. Thank you.
All right, thank you, noble colleague in the noble profession. Purpose of valuation, very clear. Why the valuation is required. But what is meant by basis of valuation? Because a lot of us have spoken, and I can see where we are, having that problem. So basis of valuation, in actual fact, basis of valuation is the value concept that is prescribed by the purpose of valuation. So it is your purpose that will give rise to the basis of valuation, not method. Method of valuation is another fundamental of valuation. Method of valuation, these are the procedures that you use in carrying out valuation, depending on the purpose and the kind of property you are dealing with. Are we together? So basis is now that value concept, the value concept that you want to arrive at from carrying out a particular valuation. If you are carrying out mortgage valuation, the value that you are going to disclose at the end of the day, it is what is called your basis of valuation. If you are carrying out valuation for mortgage, for purchase or for sale, your basis of valuation will be market value, because that is the value concept that you want to derive at. For instance, now, when you say purchase, you are valuing for the purpose of purchase. You have a client that want to buy a particular property. So you are looking at the probable sum that will emanate from between two parties, that's the buyer and the seller. And that one should be market derived. So that's what we call that one market value. So market value is that sum that that a willing buyer is able to pay, whereby both the buyer and the seller have acted knowledgeably and prudently, but it's emanating from the market. So your basis of valuation is that value, is that concept of value that you want to arrive at from carrying out a particular valuation. I hope you understand. Not the premise of carrying out a valuation, not rationale for carrying, no, but the value concept, the type of value that has been prescribed by the purpose of your valuation. So it then infers that you cannot know your basis of valuation without knowing the purpose of valuation. The purpose of valuation is the one that will give rise to the basis of valuation that you want to arrive at. When you are carrying out valuation for probate, we have said it. Valuation for probate, that is want to determine the sweat and the wealth of the deceased person. So the basis of valuation will be principal value, and principal value is the market value of that particular property as at the death date of the owner. Are we together? If you are carrying out valuation for insurance, insurance has to do with, involve two parties, the insured and the insurer. The insured is the person that wants to insure his property. The insurer is the insurance company. So when you are carrying out valuation for insurance purpose, you want to determine the sum that the risk taker will bear. That the risk taker, that's the insurer. So as to determine the amount of premium to be paid. I hope you understand now. So in insurance, the basis of valuation might be reinstatement value or indemnity value. If it is indemnity, that is, you are valuing as is. That, for instance, if for instance something happened to this a particular property, because the owner wants to transfer the risk, the building, is prone to risk. The owner wants to transfer the risk to another person. So it is that sum. If it is indemnity, it is that sum that will replicate the exact property as it is standing before the eventuality. I hope we are following. And if it is restatement, we are looking at the sum that will replicate the exact property as if it is newly built. So by and large, our basis of valuation is that value concept that is prescribed by the purpose of valuation. The value type, the type of value that we are going to disclose at the end of the day from carrying out a particular valuation exercise. When you are going out for a valuation exercise, you will have determined the purpose of valuation. That okay, the purpose of this valuation is for insurance. So, but the value that you are going to declare at the end of the day for insurance purpose is quite different from when you are carrying out valuation for mortgage. And it's quite different from when you are carrying out valuation for application for visa. It's quite different from when you are carrying out valuation for mortgage. It's quite different from when you are carrying out valuation for a whole lot of things that we have talked about this morning. And you are going to disclose a value at the end of the day. So these various values that you are going to disclose at the end of each valuation exercise is what is called basis of valuation. Please, I hope we get it now. So I don't know. Surely my boss will have something today. And,
yes. Thank you very much.
Thank you very much.
Yes, we Ridwan Balogun. Yes, I don't know if our director of studies we have something to add before we go to the next thing.
Thank you. Yes, Ridwan Balogun. Thanks so much. I think he has actually emphasized that. And the noble colleagues here should take notes. Your concern is basis of valuation is value concept. What type of value will satisfy or meet the requirements of the purpose? And it's a prescription of purpose. Each purpose has the transaction circumstances. Based on those circumstances, there will be type of value that will meet that desire. And that is basis of valuation. Now, this basis of valuation will determine what are the relevant data you will consider, for example. So if they are saying grant or measurement parameters or what have you, It's because when you identify the type of value you need, then that will determine what type of data and processes that you will adopt. So yes, everyone has actually exhausted it. The only thing I want to mention to us is that, you see, if you look at, for those that are talking about grant or all other means, when you want to give example, you give example of market value. Is that not a value concept? You give the example of fair value. Is that not a value concept? You give example of reinstatement, indemnity. They are value concepts. Even going concern, gone concern, they are value concepts. So they are not grand. As a matter of fact, we equally have what we call value premise, right? So, but basis of valuation talks about the concept of value, that value concept that will meet or fulfill the need for which that valuation is required. And as he said, it's usually prescribed by the purpose. So we should have that in mind. And that's beyond your interview. Anytime you set out to carry out any valuation, it's like a doctor who is attending to a patient. You need to diagnose that patient to know what kind of medicine to prescribe. If otherwise, you will be messing up things. You will not be doing the appropriate thing. So it's important for us to know the purpose and we know the basis so that we know, like for the example Ridwan gave in terms of reinstatement, for example, and indemnity. If you are to do valuation for insurance under reinstatement, you don't need data on depreciation. For example, but if you are to do data valuation for insurance under indemnity, that the value concept is indemnity, then data of depreciation becomes essential. Again, I handle plant and machinery valuation classes in academy. I always mention that when you are valuing, you are using the same method. If you are to value an asset, we talk about obsolescence, we talk about all other loss of value, loss in value. If you are valuing for market, for sale, or for merger, then obsolescence data become essential, just like the depreciation. But when you are valuing for insurance, there's nothing like obsolescence that you have to consider, because you are valuing their development, whether the economic obsolescence is there or not. It does not matter. So we should understand that, like another example, if you are to value, you are to determine compensation value. It's a statutory valuation, and the provision of the law is that there is no land value except grant rate paid in that year of acquisition, if it has been paid. Now, that same property, if you are to value it for purchase, will you leave land value out? You will add land value because both land and development is going. But for compensation, the concept of value, because of the provision of statute, does not include land value. So we should understand what basis of valuation is and know how to equally use it to solve real-life valuation problem. In the MCPD, last MCPD in Osun, this issue was very, it was a serious issue that was discussed, because incidentally, it has to do with distressed sales, distressed property. We are talking of sales, right? Market value, when you say valuation for sale, is market value. Ridwan, am I right?
Very well, sir.
It's market value. But when it is under distress, will it still be market value? It becomes a qualified one. And then what type of value? So you must get, and the essence is because each circumstance, each transaction, that is each purpose, has circumstances around it. Yes. Just like when you say mortgage now, for example, one of the circumstances of mortgage is that once a mortgage is ever a mortgage, so equity of redemption is there. Another one is that there are chances that if in the event of default, the mortgagor might want to salvage whatever he could salvage before the mortgagor can take over the property. And hence, therefore, we say mortgage valuation is what? Brick and mortar valuation. You don't consider anything removable or movable, right? And so on and so forth. So you can see how basis of valuation will come to determine what are the relevant data and the kind of processes you will adopt. Thank you.
Very much, sir. I think that was a very deep one, and it has actually thrown up some issues like data requirement for different purposes of valuation, or to achieve different valuation exercise. What are the necessary data requirements for differ from valuation to valuation. Okay. Then he also mentioned the another issue thrown up is depreciation. What is depreciation, and when is depreciation even when is depreciation become one of the data needed in carrying out valuation exercise? Then obsolescence also mentioned, also the processes and all of that. I'm sure by the time we follow through this process we are having, we can talk about that or do these ones too. Okay, then I have here on the chart somebody asking what is the appropriate method and basis of valuation for mortgage purposes. What is the appropriate methods and basis of valuation for mortgage purposes? The other one is investment method and market value basis. Investment method, I don't know what this person means by this. Investment method.
What the person is saying is responding to that question.
Responding to that question.
Oh, okay.
Give me answer to the question.
Okay.
That's what the guy
okay. What is the appropriate method and basis of valuation for investment method and market value? Okay. So yes, Balogun, do you have something
to? Thank you very much. To that question, yes, it depends. That's another thing. It would have taken us to another question. That's method of valuation. Because each of these methods of valuation have premise of using it. It depends on the kind of property you are valuing. For instance, now you can't say totally that the best method for investment method for property for mortgage is investment. What of if you are valuing an hotel for mortgage? Will you still use investment method? So it depends. It depends on the kind of property is it. You know, if you, let's say for instance, if it is institutional property or trade property where you can access their books, will you still use investment method? Property that we use investment method to value are those property that are currently yielding income or that can yield income. I hope you understand. Property that can yield income or property that are currently yielding income. Please, are you hearing me? Hello?
Hello,
yes. Okay. So it depends on the kind of property we are dealing with. Let's say, for instance, now a commercial complex is required for the purpose of mortgage. Yes, we can use investment method. If a residential property that are tenanted, even not even tenanted, if it can yield income, you know, there's some residential property that has not generated ₦1, and they have used more than 10 years in existence. But it doesn't mean that they cannot generate income. But they have never been put to market to generate income. So such property you can use investment. If such property are required for mortgage, you can still use investment method. But investment method is used for property that are currently yielding income or that can yield income. Are we together? Then for the basis in mortgage, it is usually market. You know, we are looking at somebody that wants to part with his money. You know, a party known as a mortgagor, he doesn't have money, so he wants to mortgage his interest. The interest, it's not the brick and mortar we are mortgaging. It is the interest that is subsisting in that property that you are conveying, that you want to use as collateral. So the person that is parting with money must get something that is equivalent to his money or more than. So that particular value that property should be market derived. So it will be market value. Then other ones that I'm reluctant to add, but is there also, Another basis that is known as a forced sale value. In some school of thought, they don't have forced sale value. And some people that said, okay, forced sale value is also part of base of valuation that we disclose in mortgage. What they do is that they just take 60%. And that's what I have problem with it. It's nothing like taking a particular percentage as a forced sale value. Forced sale value can be as high as 80–90% of the market value, and it can be as low as 40–30%. Because forced sale value depends on the sellability of the property. A property that can be quickly sold. So the selling power, the ability to liquidate that particular property into cash is what is called forced sale value. So you can see it doesn't come with any percentage. You might be, we also taught in school that is 60%. Some said it's 66. Some said it's 2/3. But no,
you know that nobody has moved in.
So I hope we are together.
If there is left.
It is usually market value. The basis are market value and forced sale value. So the explanation I have on the forced sale value is what I gave. Thank you very much.
Okay, thank you, ESV Balogun. I think to just do a kind of summary of what Mr. ESV Balogun had just said. You see, he has been able to tell us that because there are different schools of thoughts when it comes to the idea of forced sale value being a basis of valuation or not. There are different. Some people said no, some said yes. So in case you get to the interview and maybe the head of your panel or somebody in your panel is asking you about forced sale value. What is forced sale value? It's the measure of immediate sellability of the property that has been mortgaged. Then I also find that perhaps the person who has the last question was trying to talk about when he said, person who responded when he said investment, perhaps he was just looking at that, okay, maybe when you use profit method to value, you still end up in using investment method, because really what you tend to determine when you use profit method is to determine the rents, which to determine what reward go to all factors of production, and what the one that is so important to you is what goes to land, which is the rent, which you then net off outgoings and capitalize. But I want our director of study, ESV, Olalika Boderi, to also add his voice to the discussion on ground. Thank you, sir.
Okay, thank you. The issue of forced sale value has been addressed properly. The issue of method, the only clarification I need to make is that actually is established in principle, and because of these transaction circumstances, that most appropriate method for valuing property for mortgage is investment method. Now, in the case of hotel or trade properties, you still use investment method. The only thing is this. When you talk about hotel or trade properties, they are not rent generating properties. They are business premises, and where there is a degree of monopoly. So in the light of that, we use profit method, or we use quasi-profit method. Now, in using that, if you have a critical analysis of the profit method, we will realize that actually profit method alone cannot give you capital value. Yes. When you analyze profits, at the end of the day, you will result at at annual equivalent value, an annual value to the property. So the thing that at the end of the day, for you to get a capital value in terms of market value, will be for you to now introduce investment into it, which is equally income capitalization. So at the end of the day, it still falls back to investment method. Now, what profits approach there? What it does is to determine what could have been and the capacity of that property to generate annual income, looking at it from business angle. as a trade property. That is what profit method does. But when we analyze that, what you will get is an annual value. That annual value needs to be capitalized to get capital value. And that is why in some clime, like in US, why we have 5 conventional valuation methods in Nigeria, in UK, in US, they have 3 conventional valuation methods. Investment method, profit method is zoomed under investment method. They don't separate it as a method on its own. Because what the idea is, whether you analyze the rental income to determine annual value of the property, or you analyze the profits to determine what could have been annual value of the property, the first objective there is determination of net operating income of that property before you now capitalize. So in US, they don't have what we call profit method, just like they don't have what we call residual method too. They subsume residual method under costs. So I think it's still appropriate for us, giving valuation principles, that investment method is the best. That does not make it to be the only. Now, but we should have it at the back of our mind. If you look at mortgage valuation, look at the scenario of mortgage valuation. You have what we call power to appoint receiver. You have what we call power to take possession. You have what we call power to sell and power to foreclose. All these are the power that mortgagee has. In the case of power to take possession, possession we enable repayment of that loan through annual returns from the property. And the approach that will be explicit as to what the annual return will be is your investments. In the case of appointing receiver, same thing. Receivership is, for the time being, they will be collecting or running that business or collecting rent from the property while repaying the loan back. And the property will not go back after the loan has been fully amortized. Hence, it's equally a question of the rent generating capacity or income generating capacity of the property. Then you find this explicitly available in investment method. So based on these two, you can now arrive at your capital value. If it's under foreclosure, market value is suitable. When you are exercising power of sales, then for sales is suitable. And as Ridwan said, because that one is stress under distress, under time constraint. As Ridwan said, your for sales value, there is no specific percentage for it. He has said it appropriately well. And it's for you to look at the immediate sellability.
Specify the thing is, LOB, our meeting, software, like where we will buy or so near.
Are you talking to us?
I'm not sure.
Okay, so these are things for us to understand. Now, but you see, the other thing I want to have is there are some other property types that will not allow the use of investment method or even profit method. Like for example, if you are talking of church, religious places, right? Or you are talking of bare land, for example. Now, there is an established position that any property that makes the use of investment method to be impossible, such property is not suitable for mortgage. In fact, what Professor Aluko said in one of his write-up was that it does not have mortgage value. That's his word. I think that seems to be harsh. So I would prefer to choose to say it's not suitable for mortgage. Where you will be compelled to use cost, for example, because of the nature of the property, it's not a suitable property for mortgage. Because if you mortgage it and they are to take possession or appoint receiver, what would they be collecting? So we should pay attention to all this. And I think on that note, there are other comments which I think Kamaldeen should take up from the chat. Thank you.
Thank you very much, sir.
So much for your response. It is very apt, and like I said, the person who just finished speaking is our director of studies and you won't expect anything less from. Anytime it speaks, we get it thrown up so many other issues that needs to be discussed. So now, as a kind of emphasis, he said the most appropriate method for mortgage valuation is investment method. That does not mean there are no other methods, but the most appropriate method is investment method. He also mentioned that method for valuing trade properties, trade properties like hotel, motel, filling station. The best method is the profits method or quasi-profit method. Profit method has in it income capitalization method, which is the investment method. Okay, but I want him to also help us to share light on quasi-profit method, because he mentioned profit method, and quasi-profit methods seem to be, I'm sure, it seems to be a bit strange. Maybe it will be strange to the candidates too. What do we mean by quasi-profit method? And apart from that, he will help us respond to that. Apart from that, I also want him to also help us differentiate, because we are talking about interview here. During your interview, as you talk, the panelists will be looking for what you mentioned during your response that they can also ask questions on. So under mortgage, it can help us also differentiate between legal mortgage and equity mortgage. And in terms of what are the rights of the mortgagee and what are the rights of the mortgagor under each of the mortgages, legal and equity mortgage. So I have 3 questions for you now, Director of Studies. Thank you, sir.
Thank you. Sorry, I stepped out, but I think I got the last 2. I got under mortgage, equitable, and legal.
Okay, the first one, shed light on a quasi-profit method. You mentioned profit and quasi-profit. Yes. Okay,
let me take it one by one. So you try, please, and recall. You remind me as I proceed. Okay, quasi-profit method is typically referred to as throughput method. Throughput method. And what makes it quasi-profit method is a situation where, you see, for you to use profit method, you actually need the financial record, the book of accounts, well-prepared book of accounts that you consider suitable and adequate for your analysis over 3 years, 5 years, the better. But if it's 3 years, no problem, right? For profit method to be used, so that you analyze the performance of the organization, of the organization or the business in the property, and try to reduce it to what should be returned to property, to land and building, based on their contribution to that business. That's what you do in profit method. But there are cases where, for 1001 reasons, the financial record will not be available or will not be considered suitable. So in that wise, we fall back to what we call quasi-profit method, which is throughput method. And this throughput method, what it means is that you now have what we call more or less direct observation. Direct observation in terms of observing the performance of, if it is an hotel, how many bed spaces do you have? What are the categories of bed spaces? What are the lodging rates or booking rates, the lodging frequencies, and so on and so forth. Then you collate all these and look at the cost side too. You look at their restaurants and so on and so forth. This quasi-profit method is actually the origin is from for filling station, where you monitor the dispenses. How many liters capacity, how many days does it take them, what do you have in terms of revenue, what do you have in terms of expenses, then you analyze. So it's more or less direct observation, and that's to use it for hotel too. So the name actually is what we call throughput method. So I don't know if that suffices for the purpose of this. And I can tell you is what has been happening in the field. Kamaldeen is aware that I even supervise the candidates on this, the application of a profit method. I think the case study, if I remember, is actually a kind of rural valuation, hotel in a rural area.
Yes,
you know,
yes, hotel in rural, somewhere in the
rural area. You know,
your
so,
state.
so that is a quasi profits. What's the second one, please?
Yeah, the second one is legal, to shed light on legal mortgage and equitable mortgage.
Equitable. Then, noble colleagues too, please, if there is still need for any clarification on what I've said, feel free to ask. Legal mortgage and equitable mortgage. Now, the issue is this: the moment you mortgage a property, a mortgage has to do with conveying your title to a third party as a security for loan. Now, when you prepare a deed of mortgage and you will submit the title of that property with your deed of mortgage to the third party, that's the bank now, or the mortgagee, as the case may be, where the mortgagee choose to keep the document in his custody without fulfilling the provision of the statutes. And I will explain that. Without meeting the provision of the statutes. What's this provision? The provision is that prior to any alienation under your Land Use Act, there must be a consent of the governor or the minister, as the case may be. This one of the categories of this alienation is mortgage. Where that consent has not been obtained, then that mortgage is considered as equitable mortgage. It's equitable mortgage. Now, where the bank or the mortgagee had gone further to fulfill the provision of statutes by ensuring that the consent is done, then it becomes a legal mortgage. And so is that provision, fulfilling the provision of statute, that makes the difference between equitable mortgage and legal mortgage. But before I drop that, let me equally mention that there is a very close expression to what we call equitable mortgage, and that's what we call equity of redemption. Equity of redemption is not the same thing as equitable mortgage. Equity of redemption is the excess of value over loan that has been obtained. And that is what, in legal terms, it means the right of the mortgagee to redeem his property.
The right of the mortgagor.
Sorry, the right of mortgagor, thank you. It means the right of mortgagor to redeem his property back by paying back the loan. That is equity of redemption. And that is very important. Then you equally have what we call equitable right to redeem. Equitable right to redeem is different from equity of redemption. Equitable right to redeem is when the mortgagor has failed to perform, but in the eyes of equity, they grant him privilege to redeem, right? They grant him privilege under common law. He would have forfeited the property, but equity will look at it and give him another chance. That is equitable right to redeem. Why? Equity of redemption is the right that is reserved in mortgage transaction for the mortgagor to redeem his property back by paying back the loan. And that equity of redemption guarantees his reserve right. That equity of redemption equally guarantees his right to what we call second mortgage. He can equally do second mortgage without being fraudulent about it. So second mortgage will be a mortgage of equity of redemption. So these are issues around that mortgage, please. Yes, please.
Okay, thank you very much. The right of mortgagee and the mortgagor under each of the mortgage types.
Okay. Now, before I go to that, my attention was just drawn here by my team here that in our publications, under REST publication, we have had a series where we discussed about the difference between legal mortgage and equitable mortgage. So feel free, colleagues, to be part of that REST publication. We produce discussions on real estate issues, I think, on weekly basis. Now, the right of mortgagee and right of mortgagor. We have said that basically, actually, the right of mortgagor is the right to redeem his property. The right to, that's why they say once a mortgage is ever a mortgage. He reserved the right for his property to come back to him by meeting up with his own obligation. The moment he does that, he's entitled to his property back as if mortgage has never existed on it. Now, the right of mortgagee, I mentioned them, the fundamental ones earlier. And those are the power, the right to sell the property, the right to foreclose the property, the right to appoint receiver, the right to take possession. These rights are inscribed in the mortgage and the deed, but they are not operational until there is default. Until there is default. And from research has shown that in mortgage transaction, a loan is not considered to be a non-performing loan until after 90 days of default. After 90 days of default. Then if there is default, they can now start looking at exercising those rights. So these are the rights of the two parties, fundamentally.
All right, thank you very much for the for shedding light into all this. I want to use this medium to tell our participants that REST publication, we have created a WhatsApp platform. We are going to share on that WhatsApp platform the website of REST publication so that we have valuable items there, okay? So it's shown on the screen. REST publications, you can see this our YouTube page. There are so many so many interactions we have around different issues that can be beneficial to you. So please,
it will be helpful for the interview session.
Yeah, that can also be helpful for the interview. There are so many things like we can see here. Please scroll up again. Let me. We have different issues that have been treated. So you find that when you go to when you go to the website or you go to our YouTube page, you find the different issues that have been discussed by our Director of Studies on real estate. Okay, so thank you very much, admin, for sharing this. At least we can have you've seen this, and you have, for the purpose of your interview, you have few days. It's coming up on Wednesday. You can just go there and listen to something and you will add in your interview. Okay. Somebody is asking for the website of REST publication. REST publication website is www.restpublication.com. I hope I've not made a mistake. Sorry if I've made a mistake, please tell me. I think it's restpublication.com. Okay. Okay. Okay, restpublication.com. Yeah, REST Publications, www.restpublications.com. There's S in the publication. REST is RST. Publication. R-E-S-T. Sorry, R-E-S-T. Publications.com. So, okay. Thank you very much, our technical guy, who has been doing wonderfully well. Okay, so I have now going back to the chat box. I have a question here. Please, what is the relationship between Nigerian Valuation Standards and International Valuation Standards (IVS)? Okay, then okay, I think that's the question we have there. Okay, yes, the Balogun, do you want to take that?
That one fall within your jurisdiction.
Okay.
I just take it off.
Okay, I think the International Valuation Standard. Hello?
Yeah, we are with you.
Okay, international. The Green Book, that is the Nigerian Valuation Standard. The Green Book is a compilation of the International Valuation Standards and the Red Book. The red book is the one used in the UK. That's the for majorly by RIS. Okay, so the Nigerian valuation standard is done in line with the international valuation standard and the red book. Okay, and I think I understand now that the international, Nigerian valuation standard is being reviewed now, and I also encourage that you look at it, if you have a copy, though you'll be hard to buy, but try to get a copy and go through it, so that in preparation for your interview.
Okay, yeah, Geraldine, let me just pass one or two comments on that.
Okay, sir.
Thank you. That's very hard. Thanks so much. In the first instance, noble colleagues, from what I've read, you need to be familiar with your green book. Very important. They will ask you a question on it, because I've heard that you are required to even buy. So please, let's ensure that we get, we get familiar with it. Now, as he has said, it's actually compilation, but don't let's use the word compilation.
Okay.
I will advise we use the word domestication, because so that if we are saying they just compiled, it might mean another thing to the board. But it's
very correct, sir.
Thank you. Whereas it's actually compilation. That's the truth. That's the way I see it. But for the purpose of this interview, and for the purpose of what I think is not wrong for us to say we have used that green book to domesticate all this international foundation standard. Okay, so we rather say it's an instrument. The green book is the foundation Nigerian valuation standard. That's your explanation. But if they ask us the relationship, we can now say that it domesticates the provisions of, IVS and Red Book. So that with that, I think we should be seen as being familiar enough. Now, the question that I want to put to colleagues there, maybe that is what the review is actually addressing to, is the greenness in our green book. The greenness in our green book. And what do I mean by greenness in our green book? Because, for example, we have some things that are peculiar to us here. That you cannot, if you get to Ghana, it's different. If you get to UK, it's different. So that's supposed to be the greenness in our green book. Like, for example, talking about valuation for compensation. Our valuation for compensation is valuation, and it's guided with the provision of so that is part of what's supposed to be green there. They're brown envelopes, among other things that common. Yeah. So I don't know if I think that's what I want to just add. Read one thing, please.
Okay, thank you very much, sir. Okay. I think we can move to it. There
is a hand up. Somebody on our lay hands up. On our lay.
Okay.
White. You have something to say, or you want to lower your hand?
I would lower my hand. Sorry. Okay, thank you.
Please lower the hand.
Thank you very much. So I want to see that this is a convenient point for us to go to method of valuation.
Sorry, ESV, my noble colleagues, Commodina and read one.
Yes.
I think there was something I was trying to address sometime before I lost touch and I had to attend to something else. The aspect of valuation for financial reporting being for performance measurement and what have you. And I tried to refer us to IVS 300 of 2011. That is the provisions that has to do with valuation for financial reporting under IVS. Now, the basis of valuation for financial reporting is fair value. In the essence of any valuation, we take it to be analogous to market value. But the language of our clients, the companies and the financial body, the auditors and so on, is the accountants, is fair value. and they explain what fair value is. Now, in one of our webinars, I think the one handled by Professor Babawale, we try to showcase, to draw the difference between market value and fair value. That it's not in all cases that they will be the same. But that is not meant for this audience now, because that might equally create more confusion. But in the real sense of it, Professor Babawale was able to draw that difference. Okay, it's not in all cases that they will be the same. Now, but, well, it suffices to say that the basis for financial reporting is fair value. But that basis, that fair value, can be used for so many things, right? Can be used for so many things. One of it is what you call this performance measurement. For example, under IVS 300 of 2011, it identifies that the use can be for carrying amounts. It can be used for allocation of prices. It can be used for assessment of depreciation. It can be used for impairment tests. These are the 4 uses of your fair value identified by IVS itself. So the carrying amount, it represents what we call book value in our valuation for, accounting purpose in the olden days. When we say it's for balance sheets, right? We say the basis is book value. If you study what they mean by carrying amounts and you go further in the explanation, you see that it's what they mean is the book value. Now, the allocation of depreciation, and that's why, because of that purpose, that use, they ask us to always decompose value, where the asset is for income generation or where it is a corporate real estate, so long as it's not for sale. That's another thing that was introduced. Now, again, you have for impairment. Impairment is a situation where you have been carrying a figure in your book. Now you have assessed the fair value now. You now realize that there is a gap. What you have been carrying in your book is higher than what the fair value is. Then there is impairment test that you can do. So for performance measurement itself is not a purpose. It's under financial reporting. When you have your fair value, it cannot be used for so many things. That's what I wanted to explain that time. And I do hope that that is clear enough, so that we understand what in this case, your purpose is financial reporting, but the basis is for fair value. But the standard equally now explain what that fair value can be used for. And if you go to that standard, I'm sure you will see, you'll be able to read it there. Thank you.
All right, thank you so much for this wonderful contributions. I'm sure the participants are jotting down some things. I want to assure you that whatever you get here will not only be useful for your Wednesday interview, it will also be useful for your practice and for the purpose of knowledge. I also want to let you know that now that you are an associate of the institution, you are preparing to register with the boards. It is now that you need knowledge most. If I say knowledge, because there's a standard that is expected of an associate of the institution, and there's a standard that is expected of somebody who is a registered member of the institution. So what do I mean by this? More than ever before, now that you're an associate, you should seek for knowledge. Please read book. If you have not been reading books before, real estate book, update your knowledge, attend trainings, read trainings. I mean, when I say read trainings, even now that you are, don't say because you're an associate and by the grace of God, all of you will pass your ESVARBON interview. You pass your ESVARBON interview, you are now ESV, you are ANIVS, you are RSV, then knowledge stops there. No, it is even now you need it more because you must be able to have minimum standard knowledge that is expected of somebody who is an associate or a registered member of the board. So before the end of this program, we'll let you know some of the things, some of other things we do at Risk Academy. We do training for those who are already practicing for years, firms, in-house training. We've done for a couple of firms and we do training for even individuals on different topics, cutting across real estate. We do training, be it valuation, be it appraiser, real estate appraiser, agency, property management, and all. Think of any aspect of real estate. We offer training in that area, apart from the preparatory class that we do for candidates who are writing the exam. Like my colleague said earlier, this is a CSR. What we are doing today is our part of our corporate social responsibility as an academy that is registered, that is accredited by Nigerian Institution of Estate Surveyors and Valuers, that is accredited by Estate Surveyors and Valuers Registration Board of Nigeria. We take this as one of our, we've done a couple and we'll continue. This is CSR, that's why it is pro bono. But we have paid trainings, training programs, which we are going to let you know that that will be useful to you. Now, let us go to method of valuation.
ESV Commanding.
Over to you, please.
ESV Commanding.
Yes, sir.
Sorry, please, before we go to method, fallout from my discussion on concerning financial reporting, because I think I might forget. I think candidates should equally know about IPSAS and IVRS, International Public Sector Accounting Standards and International Financial Reporting Standards.
Okay.
You might be asked in the interview because they are current issues, they are current things. So candidates should equally be familiar with what is IPSAS, for example. If they say, what is IPSAS? You should be able to say IPSAS is International Public Sector Accounting Standard. What is this IPSAS is the accounting standard, that relates to public sector. The one that relates to private sector, which is the other side of the coin, is the International Financial Reporting Standard, IFRS, International Financial Reporting Standard. And their object is simple. It's just to ensure standard in valuation for financial reporting. IPSAS, let me warn here, because there were confusions before in some, I think some years back, NICE was organizing a series of lectures on IPSAS. I was privileged to equally present on some, and you see, there is this misconception about IPSAS as if IPSAS relate to all purposes of valuation when it has to do with public sector. No, IPSAS only relate to the one that is for financial reporting. That's all. For accounting purpose, IPSAS. That is the standard you must follow when you are doing your valuation. And that's why you'll be able to meet the need of your clients. Okay, so IPSAS is International Public Sector Accounting Standard. That is the meaning. And it makes provisions for periodic valuation of the asset, they said at reasonable regular interval or basis. And there are a lot of reasons for that. In the olden days, particularly in the heights of accounting, what they do is even fix as a land and building, they depreciate. If they say the lifespan is 50 years, at the end of 50 years, what happened in their book? It will be 0 year. And all of us knows that land and building appreciates. Even after 50 years, maybe it has been in 100 multiples of its original cost. So they have realized that gap. And that's what led to part of the issues that IPSAS and IFRS came to address. Apart from that, is to ensure that the eyes that were used to see valuation AI in Nigeria is the same eye that we used to see it in Canada, is the same eye that we used to see it all across the globe where they are applying the standards. So that you have standardized, there is globalization. In the word of Professor Egolom, I remember during one of the presentations he presented, I think he presented the need paper, if I remember, one of the papers in Enugu. The man said, see, IPSAS is for birds in Nigeria to sing the same song as the same bird in all other parts of the world. And I think that is very apt. And again, that takes us to mean that we must understand our valuation fundamentals, our valuation principles. You don't work or do valuation with intuitions, with discretions. What's the science of what you are doing? If you are doing that, then you won't be able to meet up with the provision of IPSAS or International Financial Reporting Standard. So international IFRS is International Financial Reporting Standard. That one relates to private sectors, organizations, companies, which are of private nature. The IPSAS relate to publicly owned companies like MDAs, assets of MDAs, government ministries, departments, and agencies, or any asset of government. When you are to value it, value them for financial reporting. Thank you.
Thank you so much for this clarification. Thank you so much. This is very apt. So for financial reporting, valuation for financial reporting in the public sector, the standard is IPSAS. Financial valuation of financial reporting in the private sector, the standard is IFRS. That's just the summary. Thank you very much again, our Director of Studies, for this wonderful presentation. I think we are going to look at general questions relating to valuation, maybe some other aspect, because emphasis is on valuation, because we know that ESVARBON interview, there's no way you won't be tested. And if I want to use my personal experience during my interview, I would say that they test more questions on valuation than, but experiences differ. Okay,
you wrote on valuation.
Oh, okay, yes. My okay. My critical analysis was on valuation. Okay, so perhaps it could be because the bulk of the head of my panel, more than 80% of the questions that was asked were on valuation. So, okay, so let's go to methods. Then we can talk about other method of valuation. ESV Balogun.
Yeah. Thank you very much, Director of Studies, mentor. God continue to preserve you for us.
Amen.
Yeah. Our method of valuation is noble colleagues in the noble profession. We have, let me make it simple. We have 5 main methods of valuation: the contemporary method, I mean the conventional method, so to say, which are comparison method, investment method, cost method, profit method, and residual method. Now, on what premise do we use all these methods of valuation? On what premise? Oh yeah, Mr. Lawale Legusi, do you want to respond? On what premise do you use all these methods of valuation?
I think somebody is raising his hand though.
Okay.
But his name is not there.
His name is Vivo 1904. Because we have asked them to register with their name. So I don't know whether this person's name is Vivo.
And I think Ridwan's question is for candidates to say, pick each of the method.
Yes.
Pick each of the methods and tell us the premise under which you will use it. What circumstances do you have prevailing that you will say, okay, this is the method, why you will use this type of method or the other. So you pick them one by one.
Thank you, sir.
Thank you so much, sir. Then the person using Vivo 1904, can you raised your hand before you ask your question, please introduce yourself. Ordinarily, we shouldn't have this because we want to know those who are, okay, I think he has been changed to Akiade, okay, Mr. Akiade Akilolu. Okay, please go ahead, ask your question. Or respond to the question. Mr. Akiade Akilolu.
Maybe he's not even there.
He just changed from Vivo to this.
Okay, it's there now. He's trying to unmute himself.
Go ahead. For investment method of valuation, we use investment method of valuation for income generating properties.
Okay.
Then for profit or account method of valuation,
okay,
we use that one for properties where there's evidence of where there's evidence of, where there's receipt. Take for instance, we use for valuation of hotels, filling station, and the likes. Then cost or contractors method of valuation. We use that one for properties that is capable of redevelopment.
You said, come again. Come again, please. Akinlelu.
Hello.
Hello.
Yeah, residual method of valuation, sir.
Okay.
We use it for property that has latent value, property that is capable of development. We use residual method of valuation.
Repeat that of cost method.
Cost method of valuation.
Yeah.
We use it for property where there is evidence of rental value, where there's evidence of.
Okay. I just want to get it. That's what you mean. Where there's evidence of rental value.
When there's evidence of rental value and when there's evidence of market value. I mean, the value of the property.
Okay.
Then the last one, I've mentioned investment, I've mentioned residual, I've mentioned profit, I've mentioned cost. Then comparison method of valuation. We actually use that one where there's evidence of comparables. Take for instance,
where there's evidence
of comparables.
Okay.
Take for instance now, I'm valuing a property now, and there are comparables in the location of the subject property where I can use as comparable to get whether the rental value or the capital value of the property I'm valuing. So we use comparison method of valuation for such kinds of property.
And you also said that in cost method, you use cost method for property that where there is evidence of rental value. Abi?
No. That's not what I mean, though.
Okay, what do you now say?
The cost method of valuation.
Okay.
We use that one in a situation whereby we use that one for valuation of special properties.
Special properties.
Yes, property that rarely changes hands in the property market.
Okay, it seems you are looking at as well. Somebody is telling you this.
I'm the only one here.
Okay.
Where we use it for special properties, like properties that rarely changes hands in the property market.
Okay.
Yes. So those are the uses for the.
All right, thank you. But stay by for correction. Also, you are not at least from, if I have to give you mark from 10, I'll give you 3/10.
Yeah. All right, sir.
That's really right. But stay by for correction. Thank you. Let's listen to another.
Right. Okay, let me raise down my hands.
All right.
Yes, sir.
Olawale Legusi, Abi. Olawale Legusi.
Okay.
Yes, sir.
Yeah. Yeah, I'm here. Hold on. I'm here.
All right. But don't go and tell your hello. Don't go and tell the panelists to hold on.
The methods. Can I speak? Okay. Yeah, and someone else is speaking. So, okay. Yeah, you have investment cost, residual method, comparative, and profit method. So profit method is basically used where you're accessing the profitability of a going concern. Basically a corporate entity or a going concern. So you want to measure the profitability and incorporate that into the measurement of your value. Comparative method under scenarios where the neighborhood characteristics afford similar properties, and you can use other properties that have similar characteristics for as a benchmark for value. Residual value, that is where you want to actually assess the value based on a development. You want to assess the value of a development, and you want to look at other aspects of where there's latent value. Say, for example, the appreciation of land apart from the buildings, and then cost method is where you use it for developing property and valuing property. That rarely change hands, i.e., churches and synagogues or religious temples and all that stuff. And investment method is where you are assessing for investment purposes, in line, to assess in terms of an investment goal or investment objective.
Okay. Is that what of residual property? Residual method.
Residual.
Yes.
Yeah, the residual aspects is where there's latent value. I mentioned that in terms of when you want to value a property and you want to incorporate the hidden value in terms of probably it's being used as a business, or there's a development, there's a latent value on the land. Correct me if I'm wrong.
Okay, thank you. Let's listen from another person. Thank you, but stay by for correction, please.
Okay.
Oh yeah, any other person? Any other person? Noble colleague? Okay, Akintoye, Akinosi.
Yeah.
Let's listen from,
the comparison method is where evidence is available of similar properties which have sold in the local area.
Yeah.
And you can use that to carry out your valuation, which have sold recently, I must add. Investment method believes that there's a comparison between the capital value of an investment and the income stream, where the yield is capitalized to arrive at the value. The cost method or the contractor's method is used.
Sorry, Mr. Akintoye, you said investment method is what?
I said the investment method believes that there's a relationship between the capital value of an investment and the income the property generates or the asset generates. And the yield is an income where you have an income flow or cash flow. And the cash flow, income flow is capitalized to arrive at the capital value.
Okay.
You have the contractor's method, which is used for specialized properties where you don't really get open market, where you don't get market evidence, such as churches, schools, etc. And it's based on the premise that the cost of construction is equal to the capital value. You have the profits method, which is used for
cost of construction. Is that cost of construction equal to what?
I said in the cost method,
yeah,
they believe that the cost of construction is the same as the value of the property. Okay. Yeah. The profits method is where you have is used for petrol stations, hotels, where you have a cash outflow, and is where you take the incomes, where you look at the accounts over a 3-year period to determine the average income for that asset, and you capitalize it. That's the profits method. The reinstatement method, or the residual method, is where you are trying to release the latent value of land, or that the property can be easily redeveloped.
On what premise will you use residual method?
Residual method is when you have a development, property, for example, or a hope value in a property, where, for example, you take
Mr. Akinosi, I said I gave you a property to value,
yes,
and you have determined within you that you want to use residual methods. What prompts you to decide that you are using residual method? That's what I'm asking.
Okay, sir. It's either where you have redevelopment land or something that can be redeveloped, sir. That's when I'll use the residual method to get the value of the land or the potential value of the land.
If I'm correct.
Hello, sir.
Hello, Mr. Kiosi.
Hello, can I speak?
Mr. Kiosi?
Yes, sir.
Please, if I'm correct, when you were explaining cost method, you said it is believed that the cost of construction is the same thing as the capital value. If you have to use cost method to value, what is the procedure?
Sorry, sir.
If you have to use cost method to value, what will have been the procedure?
To use the cost value.
Cost, okay. So after you now get the cost of the built up area, what will you now do?
Yes, we can. I mean, sorry, yes, we read one. I think for purpose of approach, let's first of all address all these premises.
Okay.
One by one.
I'm trying to.
Thereafter, we can equally, areas that we have noted and that requires correction. Okay, we correct them. Then we can now come to application processes of each of these methods.
Okay.
In fact, before we go to application processes, I have some questions to ask audience based on the premises of using all these methods that we have been discussing. After we have expressed our mind on, how fit they should have explained the circumstances or the premise of using the method.
Okay.
So let's take it one by one.
All right.
I will suggest you explain each method, the premise for using each method. Thereafter, then I can ask my questions. I have noted one or two things to correct from what they have said, but I don't want us to have misconception about. But I will suggest you pick the method one by one, the premise of using each of them, just re-articulate all those premises that they have expressed so that everybody will be on the same page. Then we can now go to application of each of the methods. What are the applications? There are a lot of issues about it. So thank you.
Thank you.
Okay. Yes, Balogun, please. Okay, because we are having issues and we have to even discuss this area very well.
Okay.
We are looking at extending this webinar to 2 o'clock. This is 1 o'clock.
Yeah.
So whatever we need to do, I think within the next 1 hour, let's do so that we can
manage time. Okay.
Manage our time. Okay. Thank you very
All
much.
Right. On a quick note, firstly, let me start with comparison method. The premise for using comparison method is when you can have, just like most of you have said, you can have rental evidence or sales evidence from property similar property that is being sold within the neighborhood. What I just want to add there is that all neighborhood of similar character, it's not compulsory the property must be within the same locality. It might be that the comparison there might be that the location have similarity. For instance, now in Lagos, I'm familiar with Lagos very well because I'm a Lagosian. Look at Omole phase 1 and Magodo Shangija, that's Magodo phase 2. The neighborhood characteristics are similar. So you can have a property in either of the estates. Let's say, for instance, you have a property in Omole phase 1 and you are looking for a comparable. Within that Omole phase 1, you did not see. If you get comparable in Magodo Shangija phase 2, you can use it as a comparison. Obviously, so it's not compulsory, it must be within the same location. Also, location that have similar.
That's why I want to find out who has been on plural.
Number 2, investment method. Like most of you have said also, investment method is used to value property that are yielding income. Property that are yielding income. Let me quickly share my experience when I went for my interview.
Hello, yes, Balogun.
Sir.
I think our director of studies wanted to say something. I heard him call your name.
Okay, on that.
Yes, thank you, yes, Dean.
Yes, sir.
I want us to be systematic about it. He has mentioned comparison. I just want to add my voice to the comparison, so that when it goes to, we'll take it
one after the other. Okay,
yes.
okay, that's okay. I think it's okay that way, sir.
So that candidate can at least have holistic view. Yes, from what the only thing I want to add to what he has said, because I didn't hear that from all what candidates have been saying, is that one, when you say evidence, there are evidences of market transaction. This market transaction, depending on what you want to achieve, as Ridwan said, it can be capital value, that's prices. It can be rental. If you are doing rental valuation, for example, you don't need capital value, right? But where you have this sales evidence, right? If it is capital value or rental value, as the case may be, in recent transactions, it should be of recent transaction.
Yes, it's very important.
It should be of recent, and this recent transaction, if it were not to be the instability in Nigeria, even 5 years down the line might still be recent. But instability in our economy means that instability, means that recent transaction really has to be extremely recent. So a measure of the recentness there is actually a function of the what? The stability or otherwise of the economy. Then number two that I want to add is when we say there are availability of this evidence of comparables or recent sales, you are not to limit it to one. So some author document that minimum 3, some says minimum 5, but in a data positive environment like our own, at least 3, so that you'll be guided, because like Professor Babawale mentioned, you are looking at market value, you are looking for market value. And we say market value is an hypothetical value. It now explains that this hypothetical value represents what could have been an average of various prices here and there. Right? So the more data you are able to analyze, the better that the level of accuracy of your valuation of your. So let's have that at the back of our mind when talking about. You see, the essence of this interaction is actually to help us in our interview, and equally to build our capacity. So when you go out there to apply comparison, follow this guideline. You don't just pick one information and you say, yes, that's what you are doing. Again, we are talking about the premise. When we get to the process of application, there are a lot of other issues around it. So for this purpose of premise, I just feel that I should add those 2 things. So that now, in summary, for you to use comparison, the premise is where there are evidences of market transactions. And this market transaction, we say recent market transactions in the neighborhood of similar characteristics. Thank you.
Thank you, sir.
So go ahead with your investment, please.
So investment method. This is the method that is used for property that gives income. I was saying that I want to.
Hello, yes, Balogun. Hello. Hello.
Hello, sir.
Yeah, sorry for this interruption. I want to call the attention of Mr. Nii Gidadu. Please, when you are not talking, kindly mute yourself.
Yeah.
Because we can hear background noise from your hand. Let it not disturb the webinar, please. Thank you, Mr. Nii Gidadu. Thank you. Please go ahead, sir.
All right. So, like I was saying, during my own interview, when I was explaining investment method, so I just said it is used for property that are generating income. So one of the interviewer was very hungry. Said, no. If that is what you have been taught in naive, it's not like that. So it's better you go. And I said, what is the appropriate user? And I said, income yielding property. So don't go and use generate. I hope you understand. So property that are yielding income. Property that you can establish the net income. I hope you understand now. So that is investment method in a very simple way. So the premise for using investment method on a property, it is when you see that the property is currently yielding income or can yield income. He has the ability to yield income if put to market. If, it means that it can generate rent. It doesn't matter whether the property is being put in the market or not. It might be in the market, it might not be in the market. The bottom line is that it must be a property that can yield income or currently yielding income. Please, I hope you are getting, you are following. So at least let's hear from our director of studies for his own contribution.
Yes, thank you, SV Balogun. Yes, our director of studies, please.
Well, basically, the premise, the only thing I need to mention there is this, that in property that is income generating or has capacity of income generating. Balogun mentioned that earlier too. It's not compulsory that you must see income coming from the property, because the owner can build and keep it. But where is an asset that is capable of generating income, then you use investment. And equally, if the purpose requires it, if the purpose requires it, then the nature of the property, and also, okay, can we use investment? So where is an asset, is a property where it's capable of generating income. That income can be in terms of rental value, can be in terms of return to land or to land and building from profit method. So where you have that, then we use investment method. That's what I just want to have. So because incidentally, I think some people have been in a consortium to carry out valuation for a big organization. And some of the team members were saying they are not collecting rents on the property. But the property is capable of generating rent. If it's capable of generating rent, and as a matter of fact, when you are using investment, noble colleagues, don't forget anyway, when we get to the application process, one of what we should take home is that you are not to consider the rental value passing on that property itself. Particularly, you have to assess market value. So there are a lot of issues around that anyway. So when we see the asset as capable of generating income, or is actually income, then we can use investment method. Thank you.
Thank you so much, sir. Thank you. So we go to, yes, Balogun, we go to
the next method I'm going to talk about is cost method. Cost method is a method that is used, as most of you have said. But what I'm going to ask our director of studies to explain more is what are these specialized properties that we're talking about. It is property that is used to value specialized property. But the something there, the critical thing is there, that where you cannot use any other method. Cost method is the last resort for valuer, where investment method cannot be used, comparison method cannot be used, so we now resort to cost method. So it is used to value property that rarely come to the market. They are rarely exchanged hands, like places of worship. Have you seen in a situation where they want to sell a proposed built mosque or church or shrine? Cost method is used to value this kind of property. And another one is that where you use cost methods is property that are used for trade that you cannot get access to their book, their account book, where profit method cannot be used. Then you can use cost method to value such property. In some, I hear you mentioning filling station and others. If such filling station is on a leasehold, if you can establish rent, you can't use cost method to value. Anyway, it depends on the purpose we are looking at. However, if it is a cinema house, if the cinema is on rentage, you can establish that the occupier is a leasehold. Maybe you can establish that rent is being paid. Rent is being paid. You can establish the rent. Then you cannot use cost method to value that, irrespective of how specialized the property might be. So it is used to value property that you can't get data. Unlike a comparison method where you use similar data on similar property within the neighborhood, recent market transaction. But in this one, in cost method, there are no recent market transactions. There's no even market, not to talk of recent, no market transaction regarding them. You can't get data regarding them. So you can now use cost method to value such property. Thank you.
Thank you, ESV Balogun. Yeah, that was very, very apt. And I want our participant to also know that ESV Balogun mentioned something that in a case where you have trade property like cinema, hotel, petrol filling station, and there's evidence of rent payments, that you cannot use cost method in that regard. And I also want to also say in that regard, since there's evidence of rent payment, then the income capitalization approach, which is also the investment method, will be applicable in that regard for valuing that trade property. Okay, I will now let me go to our director of studies to also to add his voice to this discussion.
Thank you.
Thank you so much.
I don't have much to add here. I think given the fact that you are giving us deadline to round up, let me make clarification on, not necessarily clarification, let me draw our attention to an area. Let's say you have a cinema, or you have a filling station, or you have hotel, as Ridwan said, where hotel, cinema, filling station are on lease, and you have evidence of renter value that you can analyze. What he mentioned now reminds me of the concept of who are you valuing for? If in the case that he has given as an example, you can have the property owner and you will have the operator, if I can use that language, right? You will have the hotel owner or the cinema owner or the filling station owner who is just collecting rents. He's not the one operating, he's not facing day-to-day routine. Then you equally have the operator of the hotel or of the cinema or of the filling station. This operator of the hotel or cinema or filling station, they are the one facing the day-to-day operations, taking books of account and what have you. The question is where you are valuing for you can't value the same for the two of them.
Yes.
Because they are not exposed to the same circumstance. Noble colleagues, where you are valuing for the owner, what Ridwan has said it appropriately, then you now have to analyze what are the potential of the rental income. What is it generating? What is it supposed to be generating? Because that is market. If you are looking at what value to a particular investor, what is generating might be suitable. But where you are looking at value at arm's length, it's supposed to be what is it supposed to be generating? What price or rent does market places on it? Rental value between hypothetical seller and tenants and landlord. Now, then you will capitalize. That's well said. But where your client, the same property, your client is now the operator. Don't forget that rent passing there is moving, is an expenses from that operator. The person enjoying it, seeing it as benefit is the owner. So it's an expenses to the operator. It's not that rent that you will capitalize for the operator. No. Now, in this case, you now need to go to their book from the financial record, apply what we call profit method or the quasi-profit approach, where the book is not suitable or is not available, right? Then part of the expenses you will remove will be what that rent that is paying out too. Before you now come to reduce it to, okay, what is the worth, the value of that property to demand that is the operator? So valuation is, just as it's an art, it's a science. It has to do with understanding and analysis and analyzing the behavior of the market participants. So we should pay attention to that. The fact that there is rent passing makes it possible that we can easily capitalize if we are able to determine the market rent that the owner is supposed to be getting. We capitalize, we get the value of that property to their owner. Whereas when you are looking at the operator, he's rather paying that rent out, but he's enjoying something for occupying that place, for running the business, not his profit. And we are not talking of entrepreneurship return now. So that is where the aspect of in that circumstance again, you must now come up with either your profit or your throughput, which is quasi profit. Let me give you an example, noble colleagues here. We did one valuation of a property, I think about 24 flats, luxury. Our clients happened to be the owner of the property, who gave that land out to a developer. The developer built the property. They donated, they released some unit to the clients. Maybe take it to be 4, I can't remember now. And they have, as at that time of valuation, the clients, our client who happened to be the owner of the land, is equally a lessee. He had 32 years to go. The developer had 30 years to go. Now, if you are to value, you see, the valuation has a lot of implications and complexities. It's still land and building. We are valuing for a company that owns the land who had given it out to developer. And during the time they needed money, they have sold the unit they allocated to them. So what they are left to enjoy is the ground rents, peppercorn rent reserved between the developer and them for the next 30 years. And their own lease has 32 years to go. Meaning that they are left with what? Just 2 years reversionary interest. So a valuer will be doing very wrong thing where you now see that it's 32 years and you capitalize the rental value of 24 flats, luxury flats for 24 years, for that 32 years and say that's their value. You are in the bush. But if we are looking at the perspective of the developer, well, we now say, okay, the developer has 30 years and is supposed to enjoy rent passing or the market value on these 24 flats for the next 30 years, paying the peppercorn rent to the landowner. You can see the nomenclature, please. So this is very important for us. Who are you valuing for, therefore? Is equally part of what you must put in the mind, where particularly you have varying interests. Now you have varying interests. So I think that's what I wanted to add to what Ridwan said. Just
all right. Yeah. Thank you very much, sir. So from what you have said now, we have been made to know that valuation involves the interpretation of the behavior of various market participants.
Exactly.
Yes. Thank you very much, sir. That's a good one. Okay. Yes, Balogun.
All right. So the next topic the next method we are going to now is profit method. Profit method, this is a method, from our discussion, you will have known the premise for using profit method. From what our director of survey have been saying, from what I've said, you would have known the premise for using profit method. The premise for using profit method, is where the properties are used for trade. I hope you understand, where the properties are used for trade. Property that it is the activities inside them that are the one generating income, not the property itself. In residential property, where we let property out, it is that accommodation that is, it is the accommodation that is yielding the income. But here, it is the activity inside those buildings that are yielding income. Take, for instance, a cinema hall. It is the activity inside the hall that is actually producing income, that generating income, yielding income to the owner, not the brick and mortar. Also, for instance, now, this academy, let's say, for instance, we have our building. We run several training. We run preparatory class, master class, and all that. it is and we are not even renting it out to anybody. So it is the activity inside that building that is generating income. So in that kind of property, you use profit method. Are we together? Also, property that have virtual monopoly, there's element of monopoly. So you use profit method to value that kind of property. Also, property that are operated within a business environment. You use profit method to value that kind of property. Summarily, it is used for property that activities inside them that are the one generating income, not the property itself. And lastly, property that that you can have access to their books, to their account book, to their record. You use profit method to value them. For instance, I want to value 7-Up or Guinness. You know, they are used for trade. You can have access to their book, access to their purchase. You can have access to their gross earnings, gross receipts, purchase, opening and closing stock, expenses, and all that. You can have access to them. They use profit method to value such property. Thank you very much.
Thank you very much, ESV Balogun, for this wonderful contribution. I want to, let me quickly call on our Director of Studies to make its contribution before I read the question on the chat room. Yes, your body is.
I think yes, Balogun had give appropriate explanation. And just summarily, we say you use it for when it's a business premises that enjoys a degree of monopoly. It can be virtual monopoly, it can be legal monopoly. That's when you use profit method. That's when you use profit method. So basically, but I mentioned earlier that you see, if you look at cost method, for example, unless you decapitalize, cost method will only give you capital value. When we say we use investment method will give you capital value. Comparison can give you both capital value and rental or annual value. When you are using profit method will lead you to annual value, then capitalizing the annual value will give you capital value. So those are just little things that I think I should have. I think it's well said. Thank you.
Thank you very much.
Yes, we come in. Okay, if before you come back to read the charts, let me ask. I want
to have one method to go.
Oh, okay. Go ahead with the one method before I now start asking my question.
That's the residual method.
Okay.
So residual method is method that is used to value, just like most of you have said, property that have latent value, property that have hidden value, redevelopable value. But it's not only bare land, because most of you have said it's used to value land. It's not only bare land. You use residual method to value property that are not generating optimum return, that are not generating what it should generate. For instance, an highly dilapidated building, property that has reached its total obsolescence, but it's still, people are still, residing in it. So we want to value that kind of property, maybe for the development or something. The best method is to use what? Residual method of valuation. Not only land. Okay, for instance, there are some land that you are going to even use comparison method. Any property that is not situated within commercial area. For instance, on our way now, let's say for instance we have a beer land on our way, or any other commercial road. It is, and it's for purchase or for maybe a development or something. So definitely, appropriate method is to use residual method. And another thing that you must understand, you must note here, you can't use residual method where you cannot where you cannot get approval for the prospective developments. I understand. And it's not just for only site value alone. You can use residual method to determine developers' profits. You can also use residual method to determine highest and best use. You can also use residual method to determine intensity of use. How do you understand now? So residual method is that method that is used to value property that have hidden or latent or developable value. Thank you very much.
Yeah, thank you. Let's read one.
Yes, sir.
Yeah, that's well said. The use of residual value, before you can say that there is potential, redevelopment potential or development potential. Redevelopment potential where there is an existing development that does not represent highest and best use. Development potential where is the pocket land in built-up area that has development value. What that means is that in either way there is latent value. But whatever development that we consider suitable, the condition attached to it is that planning approval must be feasible.
Yes.
Planning approval must be feasible. Where planning approval is not feasible, that means development itself is not legally feasible. Hence, you cannot consider that. That does not make the residual method to be applicable.
Yes.
So the premise requires that one, there is latent value for specific developments, right? And that that latent value for specific developments, I mean, that development that portrays that latent value is capable of obtaining approval for physical planning. So that's about that. Now, while we are waiting for ESV, let me quickly now go to questions around this premise. And these questions are meant for audience, for candidates, because ESVARBON might not ask you what are the premises, but they will ask you implied question that you need to guide yourself, based on your knowledge of the premises, under what premises will you use this? So the first question in this regard, I say that assuming, okay, before I go to the questions, let me quickly do one or two clarifications. One is costs and costs. The guy that mentioned cost says that the premise of using cost is that you consider cost of development as capital value. That's not appropriate. Rather, the use of cost, the condition that support the use of cost is what we call principle of substitution. Principles of substitution. That's what it will take you or require you to achieve a substitute asset. You won't pay more than that for this asset. That is the principle behind that. And that's if you go to your cost, you see that it's not just cost of development. Land value is equally part of it. So now, another one I want to clarify is that the guy that was talking about residual method mentioned hope value. I want to mention that there is hope value, but hope value is not latent value. Hope value is not latent value. Hope value means another different thing. And hope value means gone concern value. Hope value means gone concern value. Value in liquidation value. That is the meaning of hope value. So let's be careful when attending interview in technical sessions. We have to be mindful of our choice of words because each field adds its own peculiarity. Just like when we explain basis of valuation, every English meaning of basis, we mean maybe the ground of doing something or the reason behind doing something. But in valuation terminology, it's an expression that has its own meaning. So hope value in valuation means liquidation value or gone concern value. Please let us take note of that. Now, my question is this. A bungalow, and I'm putting this to the entire candidates. You are to assess, to value a bungalow which is on 1,000 square meters. This bungalow is presently being used as an administrative office by a church in a street, a commercial street with multiple floor buildings. In a street, a commercial street with multiple floor office buildings. What method of valuation will you use? You are to value a bungalow on 1,000 square meters, presently being used as administrative office by a church. And the bungalow is, the side that the property is along a street where it's fully developed with commercial office building, multiple floor office buildings. What method will you use and why? So audience, please. I'm listening to you.
Sir, please come again with
residual methods.
Let me come again first, but just for inclusiveness.
All right, thank you.
You are to value a bungalow on 1,000 square meters. The bungalow is presently under occupation of a church as an administrative office. And this bungalow is situated, this property is situated along a street, which is a commercial street, fully developed with multiple floor office buildings. So the question is, what method will you use and why? Yes. Can I call name?
Yes.
I want the old timer to talk. It's like a discussion on this platform are between about 3 or 4 people. So let's another person talk. Otherwise, I'll start calling name.
I would say that the residual method will be used, and the reason is the ability, the highest and best use of the land is not the current bungalow that is on the land. It has the ability to make more and to yield more. So we will use the residual method.
Okay, thank you so much. Thank you so much. You see, and that is arts. But the only thing she needs to have added is that you see the description of that neighborhood is to let us know that the bungalow does not represent the highest and best use, and that there is potential for higher multiple floors that you can actually redevelop the bungalow for. And you have a probable use, commercial office buildings. Thank you so much. That's apt. Okay. You are to value. Are we together? You are to value an operational filling station. For an operator of the filling station. What method will you use? Where, one, there is book of financial record. 2, where there is no book of financial record. So I need us to answer before I call you. Yes. I will call Nemo.
Okay, let me attempt, sir.
Okay.
Well, you want to attempt?
Yes, sir.
No, you have been attempting before now. Don't attempt.
Okay, let me hold on for someone else to attempt then.
Let other people participate.
Oh, good
Mustafa, Olayemi, yes, go ahead.
Sir. Yeah, I will try. I would like to attempt, sir.
Yes, go ahead.
Okay, I
so
think
where we have record of
who
record
is
of
talking?
account.
I have Olayemi. Who is on the floor again?
I am
Please
the
hold
one
on to
talking.
Olayemi first. Mustafa Olayemi.
Sir. Okay, sir. So where we have record of accounting I think it is best we use a profit or account method. Can you hear me, sir?
Continue. Yes, we are hearing you.
Yes. Okay, sir. So, and where there is no record of account, so we should use a cost or contractors method.
Okay. Any objection to that? Any comments on that? Any objection to that?
Good afternoon, sir.
Good afternoon.
Yes, I would like to add and.
What's your name? Your name here is saying
okay.
Image of it.
My name is Ayobam, sir.
Your name is?
Ayobami.
Ayobami, okay, go ahead.
Oh, okay. I think in a situation where the book of accounts is not available, I think the quasi profits method would be used instead.
Okay, thank you. So that we don't waste time, that's correct. We use quasi profit method. It should be our last resort, extremely last resort, fall back to costs. And I think it will be sheer act of laziness if we are unable to use quasi profit method. And we are now resorting back to costs. Okay, so let's quickly go to, you have to value for insurance. To value for insurance, a building on 5 floors that is in a state of disrepair. What basis and what method of valuation and basis of valuation will you consider? If one, you have to, okay. No, I should put it this way. How will you approach, what method of valuation will you consider? And how will you a concept if you have to value under reinstatements and if you have to value under indemnity? You are valuing for insurance a building that requires massive repair. That means it's not in a good state. And you have to value under reinstatement and under indemnity. What method of valuation will you use? And how will you arrive at your, what will make difference between your value concept, the opinion of value? Okay, as far as I see, you can go ahead. Abi, is there as far as is? Go ahead, I see your hand up. Go ahead, please. Our time is running.
Hello.
Yes.
Hello,
As
sir.
far as is also. Kamaldeen, you are welcome back.
Yeah, I'm sorry.
Hello.
Yes, I had network issue. I'm back now.
I can understand the problem.
Okay. Yes, I want to.
As far as is raised his
Hello,
hand,
sir.
let him talk. Yes.
Hello.
Hello, sir.
Yes.
Hello, sir.
Yes, go ahead, Assis.
Hello.
Go ahead.
Okay, sir. So the appropriate method that I'm going to use is cost method, actually, but it will have a slight modification depending on the basis I am going to adopt. Okay, for indemnity, the cost method that I will depreciate land structure. Then for reinstatement basis, it's still the same cost method, but then I will have to ignore and depreciation and consider modern, like I'm using like I don't get it. But that's this I will use for reinstatement.
Assis, okay. In a simple words, let somebody rise to assist ablesses now, expression not well. One simple expression, how we hold for new. Hold.
New for hold.
New for hold. Please, let's right.
Hold, hold as
hold as is a new property. And that's why you are ignoring depreciation. Now, before we leave that, under insurance, yes, you don't consider land value, and you have mentioned that. Noble colleagues, I guess you note that. That's a very good question. Is that land value is however, there is something you consider in lieu of land value. What is it? Huh? Under insurance.
I didn't know, sir.
Under insurance, you don't consider land value. And the reason is simple, is because land is indestructible. It cannot be destroyed. So you don't need to, in the valuation process, you still have element of data elements that you consider in lieu of yes, who is answering? Nobody?
Besides two.
I will start calling him.
Besides
Pardon?
two. The title. Title to the land.
Insurance does not recognize you.
Consider the loss of rent.
That's the
Yeah.
valuation where title is of no consequence.
Yeah.
Even if the tenure is 0 year,
Yeah.
the value of insurance is, because you are considering the development there. So in lieu of land value, what data information will you need?
Ground rent, sir.
Sanusi
Loss of rent.
Yes. Right.
You said what?
The ground rent, sir.
Ground rent, are you doing compensation?
Is okay.
If
We
it's
consider
valuation
the
for
loss of rent.
compensation, that is not in lieu of land value now. That's part of
Okay, sir. How about
losses.
costs of debris removal from site?
The loss
That is
in
more of it. Cost of making the land redevelopable. That's more appropriate. It might not be needed to debris removal. For example, we think that land is not destructible. What of in case of volcanic eruption? We are lucky in this part of the world that there's no eruption. What of if you have to go and practice where there is eruption? And the plane of land has been distorted. You still need to make it developable. That cost of making it developable, among which in our locality here will be cost of demolition. Thank you so much. Thank you. It's like you wanted to say something.
Yes, thank you very much, sir. Everybody can hear me.
Yes, we can.
Okay. Yes, I think there has been an omission here. We have in the house, we have 2 faculty members here. I don't know how long they have been here, but my attention has just been drawn to the fact that we have ESV Rahim. Yeah, we have also ESV Taiwo Tunde. These are our faculty members here. I think with Bashir Rahim, I want to give you the floor to just say hello to the house while we are trying to take the next action. Thank you. Hello.
Are you
okay.
sure we have Bashir Rahim?
Yes, I can. It's on. is on. Okay, but yeah, let's take ESV Omotunde Taiwo, where we are waiting for ESV Bashir Rahim. ESV Omotunde. Okay, because time is not, this is just 3 minutes to 2, and we still have a lot to do. I don't know, we may have to extend it to, so depending on what we still have on ground to touch. Okay. Balogun, are you still with us? Is CSV Balogun still with us?
Okay. I don't think so. Maybe the internet.
I think maybe the internet issue. Then ESV Bashir Rahim. Okay, I think we can go on with the next question, sir, because of time.
Okay, thank you. Your firm is to value an office building on a fully developed commercial.
Okay, give me a few minutes, please. Yeah, for 1 o'clock. Yeah. Okay. Okay. Bye.
Back. Balogun is back now. Read one. Kamaldeen.
Okay. Yes, the Balogun. Yes, sir. Yes, Balogun, are you in?
Hello, is anybody hearing me?
Yes, I can hear you, sir.
Balogun is back.
Okay. Yes, Balogun.
Oh, or maybe he's just there. Maybe he's not. Okay, let me continue.
Okay, sir.
You have a question that you are to value a property commercial building on a commercial road for mortgage purpose. What method will you use and why? Yes, that's simple enough. I'm listening.
Come again with the question, please.
Kindly come again, sir,
Commercial
please.
building along commercial road for mortgage purpose. What method of valuation will you use?
Hello, sir.
Yes.
Hello, sir.
Yes.
Investment method.
Yes. We are hearing you, assist. We are hearing you, assist.
Yes, sir. You're going to use investment method because that's the appropriate method. Because it's actually a commercial property. That is constantly yielding income. So the best approach to use is investment method, sir.
Okay, thank you.
Okay, I have another hand up, sir.
Okay.
I have Mr. Abubakar Mohammed. Abubakar Mohammed. Please, you have the floor.
Hello, sir.
All right, go ahead, please.
In actually considering the commercial property in a commercial district, we can equally use a comparative method of other property that have been recently valued to get the rental and then to get the other commercial per rate per square meter in terms of values.
Thank you.
Hello.
Hello, we are here.
Hello.
Yes, sir.
Thank you. Except
that
you have. Thank you. Except that you have ignored the factor or the consideration of the purpose that I mentioned. If I had not mentioned mortgage purpose, if I have just said for sale, then you are open to use either comparison. In fact, comparison will be the best. Then followed by investments. They are market-based methods. But where I've delimited my scope to say for mortgage purpose. And the principle is that the best method for mortgage is investment, particularly where it is feasible and practicable. So hence, I've given from my question that it's practicable for you to use investment, and I've equally delimited it to mortgage. So instead of saying comparison, mortgage is the most appropriate answer. Comparison is correct, but not most appropriate answer in this circumstance. I hope that is clear.
Yes, sir.
It's a better answer. It's a
Yes,
better
sir.
answer. However, let me emphasize here, for colleagues that have been working in one firm or the other and are going for ESVARBON interview, you don't use cost for mortgage. I know that in most firms with the accountant we have been having, they use costs, length and breadth times whatever figure. Don't go to ESVARBON and say you for commercial property when it is for mortgage or for mortgage transaction, mortgage valuation, you use cost. No. So please, let's take note of that. There's this story I told one of my colleagues years back. When we were doing our own election, I think I did my own after that when a colleague was to go and do his own. And it was even my colleague from school. And he failed that interview, not of ESVARBON now, of naives. Why? They asked him this question and to say that for mortgage purpose in a commercial street, a commercial property, what method? He said cost method. Is that cost method? He said yes. And he thought he was one that came to report to me that he emphasized, yeah, cost method, you will do this, you will do that. You know, at the end of the day, he failed that interview. They referred him that he should go for 6 months before he could come back. What that means, and why did he say so? Because that's what they were doing in his office. So get the principle right, please. And these principles are what valuation is supposed to be, not the way that people will say what you learn in school or what are the theories and principles, they are different from the practice. No. Capital, no, please. So if you have been practicing or you are working in a firm that have been practicing differently, other than what we are saying here, then please take to what we are saying here. In the best interest of your success, in the interview, and even in the best interest of the way you practice, so that we practice normally following best principles. Thank you. I think we can now go to the processes of applying the methods. Come on, please.
All right. Thank you so much. Let me
questions on processes. I think Ridwan is back. Ridwan, you were to ask questions on processes of applying all this method before I requested that we should.
Hello, sir.
All right.
Ridwan.
Hello, sir. Hello.
Yes.
Hello.
Yeah, hello. It seems Mr. Gordon.
Yes.
Yes,
I
please.
don't know what's happening to this network. Okay. Yes. Yes, sir. Okay. Before we go to process. Hello, sir. Hello.
Yeah, we are with you.
Okay. Before we go to process.
Come on,
first, I will. Okay. The network is. Okay. Can you hear me now, sir?
Yeah, we can hear you.
Okay. Before we go to the process, I just want to share a question on valuation, which I was asked during my interview then. And the question is, if you are to value a bungalow, a 5-bedroom bungalow, you have to value a 5-bedroom bungalow for mortgage purpose and insurance purpose, that would there be difference in terms of the value if you are valuing for insurance purpose, whether for indemnity or for restatement, would there be, and the mortgage, the same 5-bedroom bungalow, would there be difference in value? And if there will be difference in value, what we account for the difference in value? Okay, let's go to processes. So ESV Balogun.
All right, thank you.
Valuation for, okay, let's begin to pick the purpose. I think a few of the purpose because of our time. Then let's go through the processes. Thank you.
Yeah, the process. At least our time is almost. I think he said we are stopping at 2 p.m.
But maybe we may extend because I'm actually looking at maybe we talk generally. We have, our concentration has been on valuation, which is the major thing, which is the main thing for this webinar. maybe if we have the time, in another 10 minutes, talk about other advice on other areas where the candidate should concentrate on. Not necessarily we go into the detail of those things, but advice as to what other areas they should look at apart from valuation. So we can then say in the next, can we take quarter past, okay, let's say 20 past 2. By 20 past 2, we'll round up so that we can allow for this. Thank you very much.
Okay. So the process, let me quickly take them one after the other. When you are considering comparison, the process, the procedure of comparison, like our director of studies have said, at least you must get at least 3 comparables. Similar property, similar to the subject property, similar to the property that you are valuing. So the procedure is you establish the sales. If you are, let's say you are valuing for capital value, you want to arrive at the capital value of the subject property. So you get the sales price of each of the comparable. Please note should be we should take note here. Not asking price. Not asking price. Completed sales transactions. And we must, and we have to be very careful that it is the actual price that exchange hands, not like the way we do it in the market. We'll top it. Topping, is not market value, because we will not get the actual market value. The sales price might be, say, 30 million. Because of some interest and other, you had like another 10 million. So here we should be able to determine the actual market price of all the comparison. So having determined all that, there are objects of comparison ranging from title of the property, neighborhood characteristics, accommodation details, construction details, which other one, and all these objects of comparison. This is very technical, because some people used to think that comparison method is very easy, because you have to be very careful. You play both sides will come into play here, where, let's say for instance, object of comparison in any of the comparable is more than the subject property. What we are trying to do is that we want to equate all the comparable, we want to bring it down, bring it to the level of the subject property, where an object of property in any of the comparable is higher than the subject property. Let's say for instance, the subject property is 4-number 3-bedroom flat, and all the rooms are not ensuite. It's only one room that is ensuite. When one of the comparable is 4-number 3-bedroom property, but all the rooms are ensuite. It also have guest toilets. It is higher. The accommodation details is higher than the subject property. So you have to bring it down with a particular percentage. So I will bring it to the level of the subject property. Where the subject property is higher, any object of comparison in the subject property, if it is higher than any of the comparable, you less it with a particular percentage so that it will come to the level of the subject property. So you will do it like that on all the objects of comparison, and you now come to adjusted sales price. And if being we have it, I will have prepared that grid pattern and share the screen so that you understand what I'm saying. So you analyze all these objects of comparison and now come to adjusted sales price of each. You now find the average, not the way some of our colleagues used to do it. Some of our colleagues, we just okay, since they are similar, they are 4-number 3-bedroom flat. One is sold for 30 million, another one is sold for 28, another one is sold for 31. You now add it together and find the average. It's totally that's kind of survey is a scattered survey and not a chartered survey. So because there are some objects that distinguish them, the fact that they are not on the same land I've already distinguished them because there's no two properties that are totally identical. The fact that they are not sitting on the same portion of land gradient in one, might be favorable. While the land gradient in another property, despite the fact that they are side by side, the same construction details, the same accommodation details, save that they are not on the same portion of land. Land gradient in one might be favorable, while the other one might be negative. So that has distinguished them. You have to analyze that object of comparison. Also, title. One might have deed of assignment. Another one might have C of O. So you also do some kind of analysis there. So that's why some of our colleagues, that's why you see them. I've seen an instances where an office in two different branches in Lagos, one in Kenya, one in VI, they value the same property for the same purpose, using the same, I don't know whether they use the same method, and they arrive at different value. Difference of 30 million. One arrive at 120 million, another one arrive at 150 million. That's a serious error. That's difference of 30 million. If you are able to sell the property for 120 million, if it's your client that is buying, the other clients, you have made him to lose. If actually the property worth 150 million and it was completed at 120 million, you have made your client to lose 30 million. And if it is on the other way, if the property worth 120 million and you buy at 150 million, you have made your client to pay extra 30 million. So you can see, it's because we are not being sued on this side of the world. That's why we are doing all kind of arrangement. So that is that that is the procedure under comparison method. Thank you very much. I don't know if
thank you, ESV Balogun, for the wonderful presentation on the process of comparison method. I think I have ESV Bashir Rahim in the house now. ESV Bashir Rahim, please, if you are with us now, can you lend your voice to the discussion on ground? Thank you, sir.
Hello, good afternoon. Hello, can you hear me?
You're welcome, ESV Bashir.
Thank you, sir. I expected the link quite a while. I didn't get it. I have to call you soon before the thing was sent. So sorry for joining lately. On the process of the process of computing comparison method, yes, Balogun has said a lot about it. But the thing I think I will have to hit is on the title. He said, then if you want to consider title, both deed of assignment and C of O, they are virtually the same. It's just that deed of assignment is a subsequent transaction on the root of title. And the only difference one can consider that under comparable method is that the duration of the length of the tenure. It's possible that deed of assignment may have a longer, may likely have a longer duration than the deed of assignment. So is the deed, the duration of the period that would not be considered. If one has 99 years, probably the one that we are using as a comparable has 99 years lease, and the one we are following has less than that. So we may adjust for the period. Then so also on land area, which he actually said, it is perfectly said. Though we need to consider the land area. If the one we are using as comparable, like 3 comparable, as rightly said, if the one is the one we are following is 1,000 square meter, and those ones that were sold, they are 1,000 plus. Maybe one is 1,002, one is 1,005, one is 1,006. So that means the one we are following has a lower value, has a lower land size than the comparables. Then we need to adjust, discount the one we are following for the lesser land land area, so that at the end of the day we have you know, a value, an opinion of value that is acceptable. Because if you are ignoring the 200 square meter in one of those comparable, and you are saying, no, since this one is 30 million, this one must be 30 million, they have the same features. It's possible that there are features like if the comparable is 4-bedroom, the one we are filing is 4-bedroom, and it's possible they may have everything, all the features might be the same in terms of confidency, in terms of finishing, but the land area is different. So you have to, you know, adjust for the land area in order to do justice to that. And that's what I want to add to it, because he has said it all. Thank you, sir.
Thank you so much, SB Bashir Rahim. Our time is fast spent, and I don't know how we are going to handle this time issue. Really, valuation is not really something. Hello,
sir.
Valuation, we are putting together.
Coordinator.
Hello, yes, sir.
Please give me just 2 minutes. I want to excuse myself now. I have another meeting.
Okay.
So I will excuse myself so that I'm happy Bashir is there now. And Ridwan is online. You are there. So please, you can now continue until what you normally do at the academy. You cannot continue until the end of the day. But you will have to excuse me. But let me lend my voice to this issue of comparison. Incidentally, one of the webinars organized by RIS Academy, subject which was approved by ESVARBON, actually. I think those webinars, those series of free webinars that we applied for, one of them has to do with comparative, you know, the use of comparison method, analysis of comparability, if I remember. The two speakers have spoken well about the need to analyze for comparability. It's not just enough to just find the average. That's the argument here. You don't just find average of figures. And that means we should be more detailed in collating data when we are to use comparison, so that we will be able to identify features that drive value. And those features that drive value are things we will analyze for differences and for comparability to arrive at the summation of the average or weighted average and now get our own value. Now, what I want to mention here, particularly because of international best practice, is that under comparison method, this analysis will have two major approaches, even though we use the average commonly. But the two major approaches is what we call the endonic approach and the grid analysis approach. After your exam, after your chat, I will encourage participants here to go and study. Endonic requires regression. You might not bother yourself much about that if you are not mathematically inclined. But grid, it's only a relative relative data analysis that you do under grid, just like your frequency table. So we can go further to that, because these days, valuation clients are becoming more knowledgeable, and they're asking us for, how do you arrive at this figure, right? It's not a question of your narrations now. They want to see the science, the processes that you have adopted, particularly in a situation where you are valuing for multinationals, and they have financial consultants, or they have auditor, and so on and so forth. So let's go and study how to use what we are doing, what they have explained. You just deploy it to grid analysis. And you see, the moment you just tell clients grid analysis, they will run away, because they know that you are using your own term. And it's actually a grid analysis. You will run the grid based on comparables, and you find the weights based on element of comparability that you have listed, and you come up with your average weighted, you come up with the summation of weighted average, and that will give you what the value of your property will be. Then we should equally go further. As the academy, I can tell you, the academy is doing research seriously on that, on the practicability of endonic. That would be more appropriate for us to use. So on this note, I want to congratulate in advance many of our participants here that have deemed it necessary to join. I want to believe that we have added value one way or the other to you in preparing for the ESVARBON interview and to you in the process of becoming a chartered surveyor and not scattered surveyor. I beg your pardon to take my leave now while I leave the floor for the other capable team members. Thank you.
Thank you so much for your time.
Thank you so much.
Yes, thank you. This has really has added serious value to the candidates. Thank you for always being there for us. Okay, let me apologize to ESV Bashir Rahim for getting the link late. In fact, when my attention was called to it, I had to quickly speak to Yusuf to do the right thing. I'm sorry about that. We're supposed to.
No problem, sir.
Yeah. So
no problem,
then,
sir.
Because of our time, I really do not want to deny these candidates the opportunity of getting the processes for other methods of applying other methods of valuation. I don't want to do that. At the same time, we are looking at time, but because I also know that we have other areas that I think maybe in order that we can tell them to look at, or possibly one or two things, one or two questions there before we close. But let us exhaust the methods, the process of applying the method. We've done comparison. Let's now move to investments or income capitalization approach. ESV, I will start this time. I will start with ESV Bashir Oladuni. He's still very fresh in the house. So let him start. Sorry, ESV Bashir Rahim. Thank you. Thank you. So ESV Bashir Rahim, please.
Okay, thank you. I thought ESV Oladuni is with us.
No, he's not here.
Okay. Thank you so much.
Yes.
Thank you so much. The investment method of valuation, which is also known as income method of valuation, is as a process. Anyway, before investment method of valuation can be classified into two. We have the conventional investment method. Then there is a discounted cash flow investment method of valuation. The conventional method, as been explained earlier by SV Balogun, is for you to determine the rent. You determine the going rent, not the rent paid, not the rent passing, not the rent the property is generating. But because it's possible that if you are using the rent the property is generating, the tenant might have been in possession or in occupation for long, and is certain that he may not pay the current rent because it's a sitting tenant. So you have to, obtain the rent going, the current rental value within that vicinity, with similar to the property you are valuing. If it is commercial property, for instance, okay, you look at it. What kind of commercial property is that? An office space? Okay, this one I'm valuing. What feature does it have? Is there a lift? Is there a generator? What you look at it and all the all other features. The moment that property is similar to the one in the market that has been let, then you can now adopt the rent. And if there are differences, as earlier said, under grid analysis on comparison method, you can also use that for rent as well, so that you can now come to the likely rental value for the one you are valuing. So the moment you determine the rental value for the property, let's say we said the commercial property, a property on 4 floors. Each of the floor has 200 square meter lettable space. There is a difference between lettable space and gross floor area. The gross floor area is the external out to out. Why the lettable space is the internal area when the voidable areas have been deducted. And what have been removed from the measurement. And what are those floor affordable area? Like the commercial property, we have the floor and we have the staircase there. You won't add staircase to it. The common part, you won't add them to it. But the area that you let out to the tenant are those lettable areas. The moment you calculate or you sum up all those lettable area, you multiply them by rent per meter square using the comparable of the recent letting within the neighborhood. Then you now multiply it by the lettable area, and that will now give you the rental value for that property. The moment you determine that, the next thing is to determine the outgoings. And outgoings is not sacrosanct that you must deduct outgoings. What would determine whether outgoings has to be considered is the term of lease. If the lease is FRI, full repairing and insuring lease, you will not need to deduct outgoings. That shows that the tenant bears all outgoings. And in that situation, landlord is not going to do anything. But in a situation where it's IRI, internal repairing and insuring, automatically the outgoings has to be deducted. And in this case, let's assume that the property is under RII. Under IRI, that is internal repairing and insuring. Then you now have to consider the outgoings. And what are those outgoings that you need to consider? The first thing is the mortgage, the management fee. Even in a situation where the owner is the one managing the property, you still have to consider the management fee because it's using a productive time that ought to have been used for another thing, for management. So he must pay himself. So the first thing to deduct under outgoings is management fee. You do you consider the repair, and if you want to consider repair, it's not by way of allocating a percentage as repair. If it's an existing property that has been under management, that is being managed, you can get record of previous repairs that have been done by the owner, except where that cannot be gotten from the owner, that you now use another property as comparable under that repair. And not only repair, the insurance is there. You have to consider insurance. In most cases now, insurance is within 1% to 2% as the insurance value. Then we have the land use charge in Lagos State, while in other states we have the tenement rate. That has to be considered. And we also consider the void, the vacancy. A property that is under tenancy or lease, it is possible that the tenant will leave one day or the lessee will leave one day, and the period within which the property will be relet or released is a void period, and that void period is vacancy period. So you needed to consider the vacancy period as well. And by the time you get all of this together, management fee is 10% as approved by Nigeria Son of Vessel Surveyor and Valuer, and consented to and approved by federal government of Nigeria. But in most cases, clients do not pay 10% as management fee. It's only in few cases. So the commonest payment of commission pay on management fee is 5%. So it's always advisable to adopt 5% as management fee, because that's the most commonest, acceptable to the client. So by the time you had all of these, you have 5% as management fee, let's assume that you have 6% as a repair, you have 1% as insurance, you have preferably about, let's say, it's like, I'm using Lagos as an example. The land use charge is, depending on the area, was around 0.037%. So by the time you had all of these percentages, you come up to a certain summed percentage, which will now be taken, or which will now be deducted from the rent. So by the time you deduct that from rent, you have your net rental value. And it is the net rental value that will now be capitalized using YP in perpetuity. And that is conventional way of investment method. So if you want to, the yield we are talking about, we all know that yield is income, market capitalization rate. So, and the way to deduct, to arrive at that, is for us to look at a similar, you can see that even in investment, there is still comparison in investment. Because for the rent, you compare other property to derive the rent of the subject property. Now, we are still talking of the yield now. You still need to do comparison. You still have to go to market and compare what are the yield that a similar property is generating in the market. You have a commercial property that has been sold. How much was it sold? Similar to the property you are valuing. How much was it sold? And what was the rent of that property? So by the time you know you ascertain the rent of that property and the market value of it, you place the rent over the market value, multiply by 100, that will give you the yield. You don't pick the yield. Valuation has gone to a level that you don't go back to Richmond and say, so area is 5%, this area residential is 10%. That is a walk to the answer. You have to go to the market and arrive at it. So by the time you arrive at that, your yield, then you now capitalize, you multiply it by the net rental value, and that will now give you the market value. And that is on conventional investment method of valuation. But what about the contemporary method of investment? Investment method of valuation, and that is discounted cash flow approach. If you look at the one we have analyzed now, the point there is that the rent is static for the entire life of the property. We are not, and in return, rental is not static. It increases over time. In Nigeria, we have 3 years rental review. We have 5 years rental review. And if you are reviewing, that means you increase it upward. But this method does not recognize that. And that's what brought about the discounted cash flow approach. So if you want to use investment method of valuation, it is always advisable. It's not as if the conventional approach of investment method is not acceptable, but the other one, which is discounted cash flow, is more technical and more analyzed than the conventional approach. And how do we approach, or how do we apply the discounted cash flow? It's just for us to determine the period of the review. Is the period of the review 3 years or 5 years? If it is 3 years, 3 year interval or 3 years interval, then that means the base rent. You first determine that. Then you now capitalize the base rent. But this particular method is very long. We may not be able to analyze it perfectly perfectly online, except if we are in a physical class. But the best way to it is that you follow those renter within the period of the review. You follow them separately. If it is 3 years review, the base rent will be capitalized based on 3 years review. The next 3 years, then there must be there must be holding period. The holding period must be determined that how many years does the client may likely hold the property before he decides to sell it, because that property might be an investment property. Then you now capital, if it is 15 years that the tenant, the landlord or the owner decided to hold the property, that means you capitalize the 3 years renter up to 15 years. Then at the end of the 15 years, you now capitalize it in perpetuity. That shows that you have analyzed, you have incorporate into your analysis the rental review for a number of years before you sell. And it's possible that the value that you arrive using discounted cash flow will be more realistic and more acceptable than that of conventional investment method. So this is the process involved in investment method of valuation. Thank you. Yes, Vikama. Hello.
I think
yes. It's not okay. Yes, Balogun. Anything to add? Yes, Balogun.
No, I'm good. Hello, sir.
Yes. Okay. What?
Hello.
Which other one do we have to talk about?
Thank you very much, ESV Bashir Rahim. Thank you very much, ESV Bashir Rahim, for the wonderful presentation. ESV Balogun, you have something to add?
No, I'm okay.
Okay, let's go to, so we are starting with you now. Let's go to profit method.
Okay.
ESV Balogun, yes.
The procedure for profit method, just like I've said previously. Sorry. So just like I've said, the procedure for profit method is a method that is used for trade properties. Property that are using for property whose activities inside it are the one generating income. So the procedure, and we have also established that profit method will lead us to annual value. So when we get to the annual value, we will now capitalize it. Just the explanation of investment method, as ESV Bashir has said, you understand it up to from the determination of net annual value that he to the net income. So me, I will take it from procedure up to that generation of annual value. So the procedure one, firstly, before you can use a profit method, it must be that you can have access to the account book. The going concern, you must have access to the books, the record books, the income and expenses, expenditure, profit and loss account, everything. You must have access to it. So the first thing to determine when you are using profit method, the first thing to determine is to determine gross receipts. All the money that comes in is either you call it gross receipts or gross earnings. Let's take, for instance, is an hotel. So you will determine all the money that comes in from lodging, from bar, from swimming pool, from spa, and from all other activities that is being done there. So all the income that come in. So you don't call it income. You call it, either call it receipt or earnings. Gross receipts. So when you now determine that, from that gross receipts, I've told you the avenues where the earnings or receipts can come. Even if it is cinema, money that they generate from viewing, money that they generate from all being done around the area. In some hotel, they have gym center, they have spa, they have playing pool, lodge, and all that. They are what is called gross earnings or gross receipts. So from that gross earning, you determine what they purchase. Maybe they purchase a mattress, they purchase, they purchase. It will reflect in the account book. Then you determine the opening stock and closing stock. So the difference between opening stock and closing stock, you determine how do you purchase this. So the total you now so these two and purchases, you add them together, less save from gross receipt, you get profit. This profit, you now you tell me all the expenses, purchasing of liquor, but all expenses, payment of salaries and wages, aside rents and rates paid in the previous. So that all the expenses, you sum totally together, now arrive at in some school taking so when you get that divisible balance, it is from that divisible balance that you now determine your profit and rent. But in another school of thought, from that net profit, there's still some deduction. You deduct before you can get to that divisible balance. So when you get to divisible balance, so it is from this divisible, you now determine the constraint of divisible balance are profit and rent. Now, how do you now determine these profits? How do you now determine rent? You know, in question, if you are handling valuation question, you'll be given straight. You'll be given take 50% as your rent. But in real life scenario, how do you determine that? You determine on the goodwill of that going concern. If we have, we have three types of goodwill. We have dog goodwill, we have cat goodwill, and we have rabbit or rat goodwill. Dog goodwill. This is the kind of goodwill that follows you. That if the going concern leave that location, the goodwill will follow them to another location. For instance, ShopRite. ShopRite, anywhere you see ShopRite, they are not the owner. Shop like Ikeja City Mall, but ShopRite is an anchor tenant. That has taken us to another question. ShopRite is an anchor tenant in Ikeja City Mall. There's nowhere ShopRite will go that their goodwill will not follow them. So it means that the goodwill is not, if it is dog goodwill, it means that the goodwill is not in that location. So it will follow the going concern to wherever location is going. So if it is cat goodwill, it is a 50% chance. If you say cat should follow you, your cat will follow you. And if you disallow it from following you, you will stay in that location. It's a 50-50 chance that the location and the going concern, they share the goodwill. It's not a question of the going concern now have the total, as in the case of dog goodwill. But if it is rat goodwill or rabbit goodwill, it means that the goodwill reside in that location. It means that if the going concern leave that location, the goodwill will remain in that location. It will not follow the going concern. So that's how you now determine your profit and rent. So if if the goodwill is dog goodwill, it means that what you are going to take as rent will not be as high as your profit. It could be 60-40, 60 for profit, 40% for rent. Are we together? If it is cat, then they will share it. It's 50% as profit, 50% as rent. But if it is rabbit or rat goodwill, it means that the goodwill is in that location. It means that you want to pay, the going concern will be willing to pay any amount for rent to retain that location. So it means that the rent in that rat goodwill will be higher than the profit. So it will be the case of 60% as rent or 40% as profit. Or it depends on the popularity of the location. It depends on the hotness of the location. You know, how the location is actually, you know, assisting your business. How you understand? So ShopRite, they usually negotiate their rent because they know that anywhere they are anchor tenants. Anchor tenant is a tenant that you know, that reside in a location, and because of that particular tenant, other going concern will come and meet them there. So an anchor tenant, you can use that to negotiate their rent. How you understand? They can use that to negotiate their rent. It means that they will not pay higher rent because they know that the owner too will benefit from their own goodwill anywhere they go. How you understand? So that's how to divide the divisible balance. So when you now arrive at your rent, as we have said, you now analyze it based on the goodwill. You analyze based on the goodwill. So you now capitalize that rent to arrive at your capital value. Thank you very much. I don't know if
thank you, ESV Balogun, for the wonderful presentation, and I think it's really very impactful. Let me just say a word or two on this, so that a kind of so that our people will not take two different things to mean the same. When ESV Balogun was talking about the, you know, when he started by talking about the gross receipts under profit method of valuation, netting, adding the net stock, whether closing stock, net of closing and opening stock, and you know, now to net purchases, then expenses, you get gross receipts. Well, I mean gross profits. You from gross profit you net off expenses, trade expenses, to be able to determine net profits. It is this net profit now that he said some people, that net profit, they refer to it as the residual balance. Okay, some school of thought, but there are other school of thought that believe that this net profit is net profit. It is going to be shared between three factors of production. Now, what do we do in profit method? You look at the business is running. As the business is running, there are four factors of production that are responsible for the running of the business. And these four factors of production, for partaking in production process, they have to be rewarded. So labor has been rewarded under expenses to be able to get net profits. Now, the three factors of production remaining are capital, land, capital, and entrepreneur. So when you get the net profit here is to be shared by three factors of production. But some school of thought will say, no, what you do is that take away capital, take away the interest to capital, take it away from it. Whatever you get is the divisible balance between land and the entrepreneur. So there are two different schools of thought. So the rent, the profit is referring to is the reward to entrepreneur. You know, all the four factors of production have their rewards. Like labor, the reward to labor is wages. The reward to entrepreneur is profits. The reward to capital is interest. And the reward to land is rent. So the profit he mentioned after the net profit I mean, after the net profit, the other profit he mentioned is referring there to the profit that the reward to entrepreneur for partaking in the business. So let's not make mistake of putting them together. So because of time, because I don't think we need to really manage time. I think we still have like two methods more. But before we go into those two methods, let me quickly say something. Now, like I said earlier, this webinar is being organized by Risk Academy, strictly Risk Academy, just to assist our candidates, our colleagues, to be able to pass the ESVARBON interview. When they say something is an exam or it's an interview, it's not something that is easy. And we don't like it when we hear that, oh, somebody went for an interview, he failed. No, we don't want casualties. That's why we try as much as possible as part of our corporate social responsibility to, come up with this kind of thing. We are not part of ESVARBON. Risk Academy as an organization is not an arm of ESVARBON. Risk Academy comprises members who are estate surveyors and valuers, okay, who are also registered with ESVARBON. So this is what we do. We are not part of ESVARBON. It is not ESVARBON that is organizing this. ESVARBON has their interview. We are only trying to refresh your memory to what you've learned before, to be able, so that when they ask you question, you'll be able to, you'll be able to answer the question. And all these things we are discussing, they are not things, we are not saying, oh, these are the things that will come out in your interview. No, that's not what we are saying, but we are just taking you through the principle and practice of the profession so that you are refreshed. And once you are refreshed, when you get to the interview, they ask you a related question or a question that is not even related, because you have refreshed yourself. It will be easier for you to, to recollect and answer the question. And this is not the only, valuation is not the only area you are going to be asked question on. It is very important. You are going to be asked question on other areas. You see, this is the first time we are doing webinar for pre-ESVARBON charts. This is the first time we are doing this. Ordinarily, you cannot cover all the different branches of our profession in one day. See how much time we have spent on valuation alone, because we just want to make sure that we do this so that you don't miss out and all of that. So the next one we are going to improve on is the next one we are going to have. We'll try as much as possible to add other areas to possibly, maybe we'll look at it, we just do a series like 2-3 days so that we can touch other area. However, even as we have, I want to, questions on valuation, because of time, I want us to just hold it here, because all these processes they have been discussing, they have in one way or the other have been discussed earlier. So now, what other areas do they ask question? They ask question on property management. They ask question on ethics. Ask question on building construction, building elements. Okay, like when you talk about when you talk about a building has substructure and superstructure. You must be able to know that from beginning, from the substructure to the end of the superstructure, which is the roof, you must know all these elements that make up a building. Okay, like the foundation, types of foundation, floors, different types of floors, walls, staircase, different types of staircases, so all these things, roof, different types of roofs, and so on and so forth. Please pay attention to that too. We cannot cover all of these here. Like I said, subsequent ones that we are going to be having, we'll find a way to inculcate this in our something. Then other areas where questions come often is the area of general academic. We are expected that you want to become a registered surveyor. You want to be carrying ESVARBON seal. I said earlier that it is now that you are even an associate. It is now that you want to get registered with the board that you have more assignment on your neck, because as you are carrying the seal, you must not put your seal wrongly where you are not supposed to put it. When you do that, it has implication, and the implication we found in the area of ethics of the profession. Okay, before I talk about that thing and before we round up, I want to talk quickly about ethics of the profession. some of the areas in the code of ethics for estate surveyors and valuers. In 2014, by virtue of the power, the power conferred on ESVARBON, there was a code of conduct for estate surveyors and valuers was reviewed in 2014. And this code of conduct touches 6 different areas. There's the area of general principles. There's the area of relationship between you and your clients. There's area of relationship between you and your professional colleagues. There's the area of avoid areas that has to do with conflict of interest, which you must avoid as a professional. There's the area of disclosure. What should you disclose? Another one condition, will you, the kind of confidentiality between you and your client, you're supposed to keep the confidentiality between you and your client. But there are other what condition. Can you disclose the relationship between you and your clients? Okay, so all of this, and I'll quickly say that as a professional, as an estate surveyor and valuer, whatever it is that transpires between you and your client, under confidentiality ethics, you are not supposed to reveal to anybody. It shouldn't be a beer parlor discussion. Okay, you must keep, that's what makes a professional. I want to talk about honesty and devotion. This is part of what makes honesty and devotion. Confidentiality, avoiding conflict of interest. And how can conflict of interest occur? You want to sell a property, you are being engaged to sell a property for a client. And this your client, you have interest in that client's property, or you have a relative that has interest in your client's property, or you have a friend that has interest in that your client's property. So by that has put you in a position that even if you as a professional, we do everything you do everything normally without allowing conflict of interest, but you have put yourself in a position to be doubted. So what is expected of you at that stage is to disclose to the client that by virtue of so and so, you may not be able to carry out this brief. And in a situation where you are the one that has interest in the property of your client, you disclose to the client. If this instruction is for you to determine the best price in the market, you want to sell for the client, your position is to determine the best price that the property will go for in the market and also sell. So it then means that if you now show interest in that property to buy the property, you have put yourself in a position to be doubted. Whatever it is you've brought out as a professional, that is the best price for the property to be sold in the market, your client has tendency to doubt. But disclosure is very key. In whatever case, once you disclose, there are instances where in practice you disclose and the client will say, okay, now what is the worth of the property? This is the worth of the property. No problem. I will say to you as so. But I will also tell you under this condition also, you must get a written commitment from the client that he has told you to go that direction. But the safest thing is not for you to deal on such property so that you won't put yourself in a position of conflict of for somebody to allege that you have offended the ethics of conflict of interest. Then relationship with client. This comes in different ways too. For instance, when you are given a brief to sell a property or to manage a property, and on getting there, you find the banner of your professional colleague there, a banner of another professional colleague, but the client has given you instruction to sell the property. Only for you to get there, you now meet the banner of another colleague. Meeting the banner of another colleague there, what that means is that instruction has been given to your colleague before. Number one thing to note is that you cannot accept the brief of any instruction that has been handled by your professional colleague if that your professional colleague has not been debriefed. It has to be debriefed before you can accept it. And you must be able to see evidence that your colleague has been debriefed. Okay? You don't just get there and just remove his banner and throw it away. If you do that, you have committed professional misconduct under the ESVARBON Code of Ethics for Estate Surveyors and Valuers. You have committed professional misconduct because you hold your colleague that duty to ensure that he has been properly debriefed and you have evidence to that. And you see he properly debriefed, you have seen the banner there. Even when he has been properly debriefed, you don't just go there and throw the banner away. You also hold him, put a call across. Oh, you saw his banner there, and you have the client has briefed you, and you understand he has been debriefed. Whatever the issue, he may just tell you that, oh, okay, yeah, maybe his colleagues in the office has not gone to remove the banner. Help him remove the banner. That's all. So that's one way. Then between you and your client, especially the issue of conflict of interest normally comes between between professional and their clients. So we must guide against this. It's very important, the issue of disclosure. I'm only saying this, you need the ESVABON code of ethics to be able to, when you go to ESVABON, they will say to you, I think it's about 1,000 or so, if it has not increased. You need all of it. Just go through it and, try to digest. Where you have any issue, you can get back to us. We can explain certain things to you in that area. Then look at area of property management too. Thank God we just finished, most of you just finished Naib's interview. You saw areas, the way they ask questions is similar to what they has in ESVABON. The ESVABON code is a bit scaled up by my own standard, because I did books. When I did my ESVABON interview, the kind of questions I was asked, it was a bit, to me, because it was a bit tougher. Okay. Then another thing we must pay attention to in ESVABON is that because ESVABON encourages specialization, so they may ask you that, what do you do in your office? You say you work, they ask you, where do you work? You say you work in so an associate. They ask you, okay, what do you do in your office? You can say that ESVABON wants to help people to pass. They ask you, what do you do in your office? If you say property management, then they start asking you, apart from other general questions, we ask you question on property management. So you cannot say you do property management in your office, and they ask you simple question on property management, you can't answer. These are reasons, these are areas where people, so try as much as possible, whatever you do, when they ask you that question, tell them and look at that area very well, study along that line, apart from the normal valuation. If you do valuation, they will ask you question on valuation. That does not mean they won't ask you question in other area, because you must be a total professional. You can't say, oh, because I do property management in my office, I do. You must, whatever you do in estate survey and valuation, whatever branch of estate survey and valuation you have chosen, you must do it in line with the ethics of profession as contained in ESVABON code of ethics for estate surveyors and valuers. Whatever. And there's no aspect of our profession that is not covered by the ethics. So it means that ethics is very sacrosanct. You must have the ethics, whether in agency, in buying and selling property, in property management, even in development. Then another area I want to draw your attention to, by May this year, the ESVABON scale of charges for estate surveyors and valuers has been reviewed. We now have, the one we used to have is the one that was reviewed in 2014. We have a new one now, which was reviewed in May this year. Please get a copy from ESVABON. Try to know, because when our candidates were preparing for exam, I had to just take them through the scale, because the scale is now different from, now we have about, I think, 5 or 6 ways by which you can charge our professional fee now. We have the man hour is there. We have the flat rate, which is percentage of whatever the value, the project. We have a graduated scale. We have the reimbursable, commitment fee. Okay, I've forgotten the 5th one or the 6th one. So you need to look at it so that we, apart from even doing the interview, I said earlier that, look, you have so many load on your head now that you are not so shy, you want to be registered. The moment you are registered, people want to ask you questions, you must be able to live by that standard. ESVABON, if one practices in a non-professional manner, ESVABON is very strict at things unprofessional practice by estate surveyors and valuers. So please, let's pay attention to this area. I hope I've not left out. Okay, there's something I need to say under, I think I want to go back to valuation just for a moment. One of the questions I noted down when ESV Balogun and ESV Bashir Rahim were talking, that I think ESV Balogun has been able to answer this one about who an anchor tenant is. If you look at the case of anchor tenants, even though he mentioned it in valuation, question on anchor tenant can be asked in agency, letting. It can be asked in property management. So anchor tenant, he has said it, the major tenant who, by virtue of the presence of that tenant, is the major tenant in a complex, and by virtue of his presence, he also draws other businesses. To because by virtue of being the other businesses want to come there. It serves as a kind of pool business, help the owner to pool other businesses into the complex. Example is the ShopRite that we have in Ikeja City Mall. Yes, answered that. Then the other one, which I noted down when Rahim was talking, was that he said, when you want to, the rent, under investment method of valuation, the rent you will capitalize. That rent is not the rent that the tenants in that property is paying or are paying, but it is the passing rent for similar property in the markets. If you are going to value for markets, if your basis of valuation is market value. I remember again that Jabose also said it earlier that if you use the rents or passing on that property, you are not valuing for the market. What you rather get is investment value, because you are now looking at the value of that property from the perspective of the owner, the investor, no longer the market. That of market must be objective, but where it is investment is subjective. Okay, so now, yes, Bashir now said, what are the, now the question is this, let me be straight. The question is, under what circumstances can the rent paid by a lessee or a tenant be lower than the market rates? There are a few cases, a few instances in practice, we have seen it in practice, when we find that rent that is being paid by a tenant in a property is lower than the market rate. What can result to that? ESV Balogun, or is ESV Bashir still here?
Is ESV Bashir there? If it's not there, let me take it.
Okay, please, so that we can, this three o'clock.
There are about two instances.
Okay.
One is if the tenant is a sitting tenant. He has been in that apartment, for a while. So it can happen that the full rental value will be higher than the rent reserve. That's number one. Number two is where the property is not in habitable state and is to be let as is. So where we use the expression, the property is to be let as is, it means that the property is not in an habitable state. So it needs some expenses to be done on it. It needs some renovation before it can be fit for human habitation. In such situation, the rent that will be paid will be lesser than the full rental value of the area. So those are the two instances that I can remember now.
Okay. Thank you very much, ESV Balogun. Yes.
If premium is to be paid.
Yes, premium, yes.
To capital expenditure.
Yes. We can liken it to capital expenditure, because the same way that we treat premium under that circumstance is the same way we treat capital expenditure. So, okay, then another one, I think there are two now. When a tenant is enjoying sitting tenant status, rent paid can be lower than the market rent. When a tenant, carries out capital expenditure,
or he
pays premium at the beginning of the lease. So this we make the rent. Then another one that I think yes, Bashir is here. Another one that I want to add quickly is that can we say where a landlord, maybe because of relationship he has with the tenant, maybe they are related, or he has done something for him somewhere before, he now wants to use a kind of paying back, and now say, okay, even my rent here is 5 million naira on flat per annum. Because of that, he say, look, no, you'll be paying 3.5 million or 4 million. So can we take relationship between landlord and tenants, or lessee and lessor, to also be one of the factors that could be responsible for a tenant paying lower rent than the market?
Very well. Not even in terms of friends now. I've seen a family where I come from, the Kwara State. There used to be this rich man. So he has many houses here in Lagos and another part of the country. Some of his house he gave it to family member. I will now be collecting a rent that is far lesser than the rent obtainable in the market. So we can actually, so if we want to carry out valuation on that kind of property, we will not reckon with the rent that is being paid on it. It is the rack rent that we're going to reckon with.
And
So
okay, thank you, ESV Balogun. And rack rent in this under this circumstance, rack rent is the same thing as full rental value.
Yes, same thing as full rental value.
All right, thank you, ESV Bashir. You are back.
Thank you, sir.
You want to add something to what we have said so far? You are our guy here, since our our director of studies is not here now.
we are all colleagues. Actually,
you are a senior colleague.
That one is
in knowledge and in time.
Actually, you have said it all. Before you added personal relationship to it, that was what I had in mind, because when ESV Balogun mentioned the sitting tenant and the payment of premium, and I know special relationship also comes into it. Even the special relationship you have said may not even be in terms of who happens to be your friend or your family. In some cases, under commercial letting, commercial lease, some landlord grant concession or rent to a company, an infant company, just for it to to get established. And after he has gained its ground, the landlord can now increase the rent. He might not even know the company from Adam, but just to help the company to get firm, to gain his feet. And by the time the company is gaining his feet, it will now increase the rent to that. So special relationship can come in form of the family, in form of the relation, in form of the friend, and it can be on a general consideration. So basically, those three areas are areas that rental can be lower than the full rental values.
Thank you very much, ESV Bashir. You see, while we were talking, something just came to my head. And because the scenario you painted actually resembled that thing that came. Do you know that after COVID, a lot of different parts of the world, even in Lagos here, some of the properties we managed, we did it. We gave what we call tenant incentive.
Okay.
And let me tell you a good example of what we did in my office for a particular commercial property in Kenya. What we did was to advise the land, because what we found was that we had two travel agency in the complex, and they would rent paying tenants before the COVID. We saw that things were hard, even for them to pay service charge. It wasn't so easy. So we now had to speak to the landlady that, look, so let's come in this way. It's a way of making even a tenant that will be ordinarily be bad before. When you do such a thing, the tenant will be, they will take you serious and they want to do
exactly.
They want to handle your property well and all of that. And she agreed that we should give them 20% rent discount for 2 years.
Good.
For 2 years. That is, we did for after COVID, we did for 2021, 2022 for them. And by 2023 now, they are paying the normal rent. So you see the something. So I will now say, based on this, I want to say that personal relationship with lessee or tenants and tenant incentive is another point. I think we have about 4 points now. When we say the first one, sitting tenant status, when the tenant enjoys sitting tenant status. Second one is where the tenant carries out pays premium or carries out capital expenditure. And the third one is personal relationship, good personal relationship with the landlord, and tenant incentive. Because tenant incentive here may not mean there's a relationship. It may just be that the landlord all over the world, it was done post-COVID. All right. Thank you very much. Yes, Bashir, are you validating all these things I've said?
It's validated already.
All right, I wanted to validate them. So thank you very much for this. We cannot exhaust everything, but I can tell you that concentrate on your area of the area of specialization. That is the kind of work you do in your office, because they are likely to ask you that, what do you do in your office? If you say you work in KB Lawa Consulting, what do you do at KB Lawa Consulting? Oh, I'm in valuation department, or I do more valuation at property management. So those areas is where they will ask. So go and focus on that. And because we have a WhatsApp group, if you have questions relating to what you do, I think, please, you can post there. We are going to, between now and when you will, between now and, okay, you have your interview on Wednesday. Between now and the close of work tomorrow, you can do that. But don't ask any question by Wednesday morning. Wednesday morning, we are going to lock the platform. You can't even post there. So anything you want to ask between now and Tuesday night, you can ask. But Tuesday night, I will tell our training attendants to lock up the platform, to change it to admin only can post, so that you can't post any question there. So whatever you get, we pray that the Lord Almighty bless your knowledge for you. I want to, okay, I have some things on the chat. Let me quickly take that so that we can round up. Please, can we have the recording? Okay, we'll speak to the our technical people to see how they can bring that out. But having the recording, if it doesn't come out tomorrow, we are not going to send it again until after the interview. Then please, can we have, okay, same question. Okay, everybody is asking for the recording. Okay, there's something here. What basis do you use to determine the rate for debris removal in an insurance valuation? Also, rate of debris removal, I think is just the cost. Do you have any, you don't apply any rate to that? Just the cost of removing the debris, or maybe you are talking about the cost of making the land buildable. And that one too doesn't have specific rate, because the damage that could be caused, they cannot be the same. It depends on what has happened to in terms of the havoc that has happened. Then may I suggest we run to first and take control? Okay, that's okay. I think so far, I'm sorry if they said, okay, how do we get the appropriate yield to be used in investment method of value? That's a very good question. How do you get yield? Now, let me tell you, why do I say it's an appropriate? It's a very good question. And I will tell you now, I've seen in practice when colleague will tell you that, oh, how do we get yield? They will tell you they assume yield of 8%. They assume yield of 9%. Yes. They assume yield of 6%. Yes. Yield is not assumed. Please go and check the green book. I check other valuation standards. Yield is not assumed. Yield is calculated. All risk yield is calculated. So yes, the Bashir is here. Yes, the Balogun. Please, maybe you just lend your voice to this. It's calculated. It's not assumed. Thank you.
Thank you so much, sir.
Yes, sir.
Thank you so
Please,
much.
Just lend your voice on how to.
Okay, thank you. We have actually talked about the yield before, but you know we have different yield. But the one we are familiar much with is capitalization yield. That's all risk yield. Okay, so an all risk yield is even the simplest to arrive at. No, and I said it earlier on that we are not in the era of going to Richmond and say residential 10%, commercial 5%. That is arbitrary, and it's as simple as anything. By a way of going, it's a way of going by comparison. Go to the market, a similar property to the one you are following. How much is the rent? The rental value. Then that similar property, has it been sold? When it was sold, how much was it sold for? Let's assume that the similar property to the one you are following was let for 300,000, and that same property was sold for 30 million naira. The best way to get is to place 300,000 over 30 million naira, multiply by 100. Whatever percentage it gives you, that is the capitalization rate for that property. It now depends. You may not use that. If it is, let's assume that 300,000 by 30 million. What would that give us? Maybe about I've not calculated it, but it might be say 3%. So if it is 3%, that does not mean that the one you are following must be 3%. So by then you are now, that's where logic in valuation comes in. Because if you have the one you are using as comparison might be better than the one you are filing. So if it is better than the one you are filing, you may decide to reduce, to increase the yield. And if it is not better, you can decide to reduce it. But the way to get it is to look for the rental value of a similar one and the capital value of a similar one. So you now place the rental value over the capital value and multiply it by 100. Whatever percentage it gives you, that is your all risk yield, which is market yield. And that is the one we use mostly. Though we have equated yield, we have redemption yield, we have all other yields too. But the one that is mostly common or commonly used in valuation is all risk yield.
All right, thank you.
Thank you so much.
Thank you so much for I want to thank every, first, let me start from the participants.
Sorry, sir.
Okay, sir.
Hello, sir.
Yes, sir.
I just want to add something. Is to the participant. You can see the way ESV Kama dresses. You can see the appearance of ESV Ridwan Balogun. Don't look at my own. I didn't put on tie. I only wear shirt. That means my dressing is not complete if we are talking of interview. So make sure your dressing is complete. Dress well to the place. There's an adage that says the way you dress is the way you will be addressed. So if you are not dressed properly, people may look down on you. I've seen a colleague who has a small stature, and we are discussing this the other time. He said he doesn't like wearing shirt alone without putting jacket. That each time he put on a shirt alone, people will just look down on him as a small boy. So that you always see him in a well presentable suit. So what am I saying in essence is that when you are going there, make sure you put on your suit. No, anyway, suit might not be the only acceptable dressing code. If you want to put on a native, it's still acceptable, but you have to put on a native that is complete. If you are wearing a native now, you must put the cap. But the best one, the easiest one that I will advise you to do is to put on your jacket, as you did when you attended naives. So please replicate same when you get to when it gets to ESVARBON. And not only that, if you get there, I'm sure the interviewers will provide a seat. You will be the first. You should be the first person to greet them. In fact, if I want to bring Islamic perspective of greeting to this, anybody that's any group of people sitting down, the people walking should be the one to greet them. Sorry, I'm bringing religion into this, but that is the advice of Prophet Sallallahu Alaihi Wasallam, that those walking should greet those sitting, and those riding should be the one to greet those walking, and younger should be the one to greet elder. So you should be the one to greet them when you get there. So it's not only Westerner, even the religion advises that we should be the one to. So when you get there, you greet them and you allow them to grant you seat before you sit down. So that's part of assessment, and they will assess your dressing as well. Please let us, dress properly there, and respect the interviewers as they are ready to respect you as well. Thank you so much.
Thank you very much. Yes, the Bashir Rahim, you have spoken from experience angle. I almost omitted that part of morals. Okay, I need to just let us know as we round up that this is a profession. You, at the end of your interview, you'll be given a certificate. That certificate will read that you have been found to be a fit and proper person to practice estate survey and valuation in all its ramifications in Nigeria. So, and to be a fit and proper person, please, it is not just by knowledge. Knowledge is part of it. Knowledge of the profession is part of it. The morals is very key, and that is what part of what the Bashir just mentioned. Morals. You don't get there. Don't argue with panelists. By virtue of their position in the profession, in terms of knowledge, in terms of even when they say something that you disagree with, don't tell them you disagree and don't say no. Please, whatever they say, even if within you disagree, just say yes, sir. And I will treat you one trick. The trick is at any point in time when you are going for such that, have a plain paper and a pen. When they are saying something and you think, try to jot down certain things. That one is for them to see how serious you are. Because in all of this, there's subjectivity in it. Everybody is cool. People who are good, who have good behavior. If you go there and you say, and don't go there and say, I'm a property management guru. If you're a guru, you don't have business going there. You don't have business, you are not, anything you do, don't call yourself guru, because a colleague has said that before. He didn't pass naive interview that year. You have to go the following year. Whatever you do, just tell them this is what I do. Don't be arrogant. Comport yourself. Don't be arrogant. You've done naive interview. I don't know whether it's everybody that just did naive interview, but please be humble. Be humble. Know that they are sitting there. They are, whatever thing you think you know, whatever thing you think you are passing through, they have passed through that stage. Then it's not limited to that. They have told you, you don't sit down when they don't ask you to sit down. We are the one that will greet them. When you go there, you greet them first, and you speak up, so that you won't have to be struggling when they say, talk, and they don't have to be telling you talk. No, speak up. Don't shout at them, but speak up for them to hear you clearly. And don't argue with them. Don't be arrogant. Be humble. Whatever they tell you, do. And at the end of the interview, when they say, okay, you may take your leave, tell them thank you. It's part of our moral. We are Africans. For you to be a fit and proper person, to practice estate surveying and valuation, it is not in the content of your knowledge alone. You must be well behaved. And that is why we have code of practice that should guide our behavior. So it is very important. Now, to round up, I can see that some people have sent their numbers that they want to be added to the WhatsApp group. I've told our training attendant to pick those numbers, you'll be added. But like I said, whatever you want to send, you can send it between now and tomorrow evening. Because you wake up Wednesday morning to see that the platform is locked. So please don't be offended. That's our way of doing things. After the interview, we open the platform again for everybody to, So now I want one of the participants to respond to all we have done today, whether we have areas that we think, or if area that we think we need to improve on. We have already noted some areas we need to improve on. We are doing this next time. Then we want you to just respond, and we wish you well. By the grace of God, pray. Not only that all these things will still pray, because everything, all work without prayer is like you are doing this. So just do your best. Look at areas, what you do in your office. Look at all the things I've mentioned, building elements, substructure, superstructure, all the things in the all these things. Just then current affairs. Thank you. Just remember, current affairs is also very key. Just like in the NIES interview, current affairs, just know what is happening this period, and maybe have. So I do not have any doubts in my mind that there will be any problem. by the grace of God, I pray that everybody who is going to partake in that interview will be successful. So let somebody respond from among the participants so that we can end the webinar. Anybody that is lifted by the spirits. Unmute yourself and respond. Just unmute yourself and respond if you want, if you wish to. Okay, Vivo 1904. That's Mr. Kilulu. Okay, I have Mr. Kilulu. I have Mr. Abubakar Mohammed. Okay, Mr. Kilulu, you can go first. Mr. Kilulu, you can go first. Okay, Mr. Abubakar Mohammed, go first. We are still waiting for Mr. Kilulu to. Mr. Abubakar Mohammed, if you are available, you can have the floor.
Hello, sir.
Hello.
I'm available, sir.
Okay, all right,
Yes,
all right. Go on.
Good afternoon, sir.
Good afternoon.
This is Akin Adi Akinlolu.
Okay.
With all humility, I want to say a very thank you on behalf of all the candidates that are going for the ESVARBON interview on the Wednesday. To be honest, you have touched all the areas. We cannot know more than you. You know more than us. And we sincerely appreciate what you have done. And we pray God will continue to be giving you the knowledge, the understanding in the mighty name of Jesus. So, briefly, I want to say this, sir. If there's any way you can help us with the recording, I believe some of us that are not online, I mean, that did not join the Zoom meeting, will be able to listen to what you have taught us, and they will be happy that even if they've missed it, at least they still have something to hear after the Zoom meeting that can be of help to them. So thank you very much, sir.
Thank you very much, Mr. Akilolu. We are going to look at the request you have made. We are going to look at it in line with our ethics in academia and the ethics of the profession too. And we certainly get back to you on the WhatsApp platform. Thank you very much. Then we have Mr. Abubakar Mohammed.
Hello, sir.
Hello, we can hear you.
Okay, sir. We really have to appreciate your kind of time and cooperation with the knowledge. And this is a very serious line guide that will help us into the interview. We really appreciate your kind gesture. We really thank you very much. We look forward to do other things in the practice, sir, with you people. We really thank you, sir. Very much, sir.
Thank you very much. Thank you.
God bless you for your time and everything, sir. God bless you, sir.
Amen. Amen. So on this note, I want to wrap it up by thanking you to all participants for coming in. If Risk Academy calls you for this and you refuse to come, there's nobody that will be here that will be talking to you. Yes, we thank you so much for your time. We thank you and we pray that as you prepare for your interview, God will, in His infinite mercy, will enrich you with the desired knowledge that will be sufficient enough for you to skate through your interview and come out in flying color. I also want to thank all the participants, our faculty members, ESV Bashir, Rahim, ESV Ridwan Balogu, ESV Olalekan Abode, our Director of Studies, and every other person. ESV Omotule Taiwo joined at the point, and every other person that joined us, I didn't see them to recognize them. Please, we appreciate you. We pray that God will meet you at the point of your need. As we do this for our colleagues, to be able to skate through the interview, at our own point of need too, we pray that God meet us there and make things easier for all of us. And we pray for our profession of estate surveying and valuation and grow from height to height. Thank you very much for participating. You can You can on your camera now if you like, so that we can say bye-bye to ourselves. Thank you. We wish you well in your interview.
Thank you. Bye-bye.
Bye.
Bye-bye, sir.
Yes.
Bye. Bye.
Bye.
Bye-bye. Thank you very much.
Bye. All the best in your interview.
Thank you, sir.
Bye-bye, sir.
Bye.
Bye-bye, sir.
Thank you. Thank you, sir.
Yes, sir. Thank you very much, sir.
Bye-bye, sir.
Ṣé money point àbí pàǹpì lẹ́ńlẹ̀? Money point. Ìdáhùn kò mo ti gbowó several times lórí ọ̀rọ̀.